Okay, good afternoon. On behalf of the Hutchins Center and Brookings Institution, let me welcome everybody, including those who are watching online. I should also acknowledge and thank Glenn Hutchins, who's here today. It's been only a little more than 7 years since Lehman's failure helped to trigger an intensification of the global financial crisis, which in turn was a leading cause of the deepest recession of the post-war period. These events demanded a strong response by both the government and the private sector. The period since the crisis has indeed seen major reforms in the financial system and in financial regulation, including, in the United States, the passage of the Dodd-Frank Bill and its implementation, the ongoing enactment of new capital and loss absorption rules agreed to in Basel, a global shift to a more systemic or macroprudential focus in financial monitoring and regulation, and under the aegis of international bodies like the Financial Stability Board, as well as U.S. regulators, new attention to critical areas not traditionally overseen by bank supervisors, including funding markets, non-bank credit intermediations, and derivatives markets. So our goal in this event today is to look at some of the consequences of the ongoing reforms. Has the new regulatory regime satisfactorily addressed the causes of the crisis? What emerging risks are there, and do we have the tools to manage those risks? Are there areas in which regulation has gone too far in that the costs in terms of reduced credit availability or liquidity exceed the benefits of greater oversight? And has regulation actually made the system less safe in some ways? We're going to address these themes today in the context of some specific issues and questions. We're going to begin in a moment with a discussion of the effects of new collateral rules. We'll turn next to the issue of liquidity in the bond market. We'll hear from Governor Tarullo from the Federal Reserve on shadow banking, and we'll end with a panel discussion on these and other issues. And there will be opportunities for audience questions throughout. So let me, without further delay, I'm going to jump to introducing the first session. The first session is about collateral rules and their effects. The presenter is Gary Gorton of Yale University. Gary is one of the world's leading financial historians and has always been a role model for me in his ability to use history to help us understand current institutions and events. He's written several books about the crisis and about banking panics in general. Gary's going to speak for precisely 18 minutes and will be followed directly by a discussion by Betsy Grasek, a managing director at Morgan Stanley Research Division. Betsy's had a distinguished career in banking analysis, including time following Japanese banks for Morgan Stanley. Her BA from Cornell, I noticed, was in Japanese studies. She currently covers large-cap regional banks in North America for the same company. So without further delay, let me ask Gary to come up.
Oh, wrong slides. We can have Daryl talk. Does this count as part of my 18 minutes? Okay, good. There you go. Okay, now the 18 minutes begins. The world is different now. It's had a fundamental change, which I describe as a shift from a system of immobile collateral to a system of mobile collateral, by which I mean that bank loans that used to stay on bank balance sheets until maturity were transformed into bonds, and these bonds could be used, asset-backed securities, for many purposes, including as collateral for repo in portfolios of asset-backed commercial paper, to post as collateral for derivatives positions, and so on. When there's not enough treasuries, in fact, the private sector produces substitutes, and this has been true for at least 150 years. So what I want to do first is show you a picture of this transformation. This is a figure that shows you the components of privately produced safe debt as a percent of total safe debt. Okay, the components of privately produced safe debt as a percentage of total safe debt. This is flow of funds data. So you can see that in 1952 or so, that by far the dominant part of privately produced safe debt was demand deposits. And what you can see is that it just drops straight down. And instead, what's rising are these two. instruments, including money market funds, repo, asset-backed commercial paper, private label securitization. This went to back this. This is composed of all the loans that you back this. Let me just say a couple things about this. One thing you need to understand is that this didn't start in 2000, right? It didn't start in 2002. It started around at the end of the 70s, right? And it's a fundamental shift. Now, and in fact, it turns out that this was the part that everyone knew about and which was regulated. Shadow banking. To the mic. Oh, okay, sorry. So if you had seen this, say in 2000, you might have observed that there was this transformation, which emphasizes that without the right concepts and theories, you don't know what to measure. There's nothing special about these data. This is Fed flow of funds data. Now the problem is that, as we saw, this new system had the same problems as the old system. It was vulnerable to bank runs. And as a result, there's all sorts of reform, which for the most part is aimed at going back to a system of immobile collateral. That's just very comforting to go back to the 60s when we could feel good. And that's because many of the new reforms require that collateral be posted and be stuck there. And in particular, the one change that is extremely important, the most important change, is the BIS's liquidity coverage ratio. The liquidity coverage ratio says, in effect, every dollar of repo has to be backed by a dollar of treasuries. So just to understand what that means, that says that one kind of money, treasuries, has to be pasted together with another kind of money, repo. Private money, repo, has to be backed by government money, treasuries. So treasuries do have a convenience yield. This is a picture from Krishnamurthy and Vissing Jorgensen, and you can see that as the ratio of treasury debt to GDP goes down, the AAA corporate to treasury spread skyrockets. So we've known for quite a while that treasuries have a convenience yield. In fact, the last two treasury bill auctions went off at a zero yield, so you're basically buying like a $10 million $10 bill. So I want to stop and ask ourselves, how should we think about this? Right, this is this major change, the liquidity coverage ratio, and how are we supposed to assess this, and how are we to think about this? So Bob Lucas, many years ago, put forth this notion called the Lucas critique, which had to do with unintended consequences. So it's something like this. Recently, the airlines adopted a policy that you have to pay $125 each direction if you take your dog on the airplane. Right? You have this little dog, you put it under the seat in front of you. It used to be free. Now it costs $125 each direction. And what happened was there was an exception to this rule that if your dog was an emotional support dog, then you could take it for free. So you can go on the internet and Google emotional support dog, and you find this doctor in New Jersey who will sell you a note. And you use that note, and then your dog goes for free. And airlines are worried that they're going to have more dogs than they used to have on airplanes. Right? So this is an unintended consequence of a policy that, no, it's not that important of a policy. But the question is, how do we think about the liquidity coverage ratio? Now, the BIS, they tried to forecast how much extra collateral was going to be needed, and there were many forecasts, and they ranged from 800 billion to about 4 or 5 trillion. And there was no serious, I would say, serious attempts to understand the unintended consequences. So I want to look at that today, and I'm going to look at that with a system that was exactly the liquidity coverage ratio. Exactly. It said that national bank notes, this one is from the National Bank of Fort Myers, Florida, had to be backed by treasuries. So the National Banking Act came into existence in 1863 to finance the Civil War. to create a demand for treasuries, but it had a byproduct which was much noted at the time, which was that it would create a national currency that would trade at a uniform price and would not be subject to banking panics, national banknotes. And the reason people had this view was because it was going to be backed by treasuries. So the problem was noted in 1913 by an economist who pointed out that there was this huge underissuance problem. It seemed as if there was an arbitrage opportunity. Banks could buy treasuries, take the treasuries to the U.S. Treasury, get their notes, and then lend out the notes. The return on the treasuries they deposited would accrue to the banks, just like in repo. You deposit the treasuries, but you get the return and you get the money you can lend out. And there were a number in the subsequent 100 years, economists calculated these so-called arbitrage profits, and in some cases they claimed they were infinite. And in fact, what happened was, if you take into account two things, that treasuries have a convenience yield and that you shouldn't be calculating the average profit but the marginal profit, it turns out there's not really a puzzle. Banks did not want to use all their treasuries to back national banknotes. And so there was a shortage of national banknotes. Now, one way to interpret that is that treasuries had another use because of the convenience yield, and the ratio of 1-to-1 was just out of thin air. It's like the BIS. The 1-to-1 ratio is not, has no empirical support at all. So what happened during the national banking era? Well, as treasuries to GDP dropped, which is the black line, the ratio of banknotes to demand deposits rose, also dropped. Notes to demand deposits dropped, so demand deposits grew. Okay, so you can see that the correlation is 0.96. Okay. So what's happening is as treasuries became scarce, and banks did not want to use all of them to back national banknotes, a shadow banking system arose. Demand deposits. And at the time, that's the puzzle in the late 19th century. Economists were writing articles with titles like, "Are Checks Money?" And there were surveys done by the Comptroller of the Currency, by the National Monetary Commission, in an attempt to find out the extent of use of checks in transactions. Okay. So the result of this liquidity coverage ratio during the national banking era was exactly, there was this rise of the shadow banking system. So, it's a little hard thinking now, looking back, thinking how could these people not have understood that checks were money? Well, they really didn't. Bray Hammond, who wrote the last Pulitzer Prize winning book in banking, the importance of deposits was not realized by most economists till after 1900. Well, not quite. Here's Russell Leffingwell, Assistant Secretary of Treasury. All of these people who believe in the quantity theory of money choose to call bank deposits money, but bank deposits are not money. So there was this fundamental confusion about what demand deposits actually were and why they had grown to such an extent. Meanwhile, there's 5 major banking panics during this period. And these banking panics are situations where people want to get the cash, the national banknotes, in exchange for their checking accounts, right? So it's not as if you couldn't observe that there was a problem with checks. We saw this repeatedly. The problem is that people didn't know what to do about it. And partly it was this conceptual confusion. The bankers by the late 1880s lobbied heavily to have what they called an asset-backed system, by which they meant the national banknotes would be backed by portfolios of loans, not by treasuries. But we had seen that system in the free banking era, and that also had banking panics. So this I want to emphasize, is an exact parallel. And I used to hear this much more often than I do now, but one response is things are different now. Things are different now. And I spent 25 years researching banking crises, and if I had a nickel for every time I heard things are different now, I'd be retired, living in a mansion somewhere. So, I think there's two points. One is, when you have such a significant change as the liquidity coverage ratio, I don't think you're allowed to just shrug off the Lucas critique. I just don't think that's acceptable behavior. And I think that it's not only with liquidity coverage ratio, but there's other examples in history that are quite close to other policy issues. This one happens to be exact. So the liquidity coverage ratio and the national banking system are exactly the same. When you paste two kinds of money together, public money and private money, it's going to cause a shadow banking system to arise. Okay? So let me add that, you know, the horizon to think about here, your horizon should have gotten longer because of the crisis. I mean, I've noticed that bank regulators in particular, you know, their horizon is about a year, maybe. And this is something, this rise of demand deposits happened over 50 years. And the first figure I showed you about the development of the shadow banking system happened over roughly 40 years. So the horizon here is a lot longer than you normally think about. And so over some period of time, we can expect the banking system, the global financial system, to morph somehow. And a lot of people are spending a lot of time thinking about how to do that. And that is going to be something that happens slowly relative to how most people think about things changing. So this was a system that basically failed, the national banking system. And eventually we got deposit insurance over the objections of economists. So I think we're going to have the same problems. We're going to have unintended consequences of another shadow banking system. And I think that like the national banking era, despite what people think, I think they're a little bit overconfident in understanding the conceptual issues about repo and short-term bank debt in general. So I think there's a very strong lesson from history here. And I would say, you know, I guess those who ignore history are entitled to repeat it.
Okay, thank you. Thank you very much, Gary, and thanks everybody for inviting me to be here to discuss my views on not only Gary's comments, but just generally as it relates to the topic that we have today on whether or not the system is safer. Just to level set, I am a U.S. large cap bank analyst at Morgan Stanley covering large cap banks in the equity research department. I've been doing that since '02, so as a result, I have been doing it during the crisis and post-crisis period, and I did just want to say, because I haven't had the opportunity to do so in person, thank you very much to Dr. Bernanke, because from where I sat trying to estimate the value of banks and their earnings during that period, I greatly appreciate all the work and effort that you had to endure. I would also like to highlight that that what I'm going to be speaking about today are my views. They're my own. They're not attributable to Morgan Stanley. And my answer to the question is yes, I do think that the regulations that we have in place since the crisis have made the system safer. That said, I do have a couple of comments that I would like to talk about in relation to Professor Gorton's piece. Two parts: one, what I agree with, and second, what I would like to add to it. First, on what I agree with, three key pieces. One, the liquidity coverage ratio, in my opinion, does reduce the velocity of bank balance sheets. Two, Treasury yields, I do think, reflect a convenience yield. And three, all other things equal, at the margin, the liquidity coverage ratio should incent banks to take some riskier assets. This isn't all bad. It's just, you know, I do think that that's, I'm in agreement with Professor Gorton on that. Just to elaborate a little bit, why does the LCR reduce the velocity of bank balance sheets? This is basically because what the LCR requires banks to do is hold high quality, lower yielding assets today to offset the risk of deposit outflows, credit line drawdowns, or derivative counterparty deterioration, things like that in a stress scenario. So what you're being asked to do as a bank is increase your holdings of treasuries, really treasuries, RMBS too, but really treasuries today to offset the potential of a stress environment in the future. And it's happened, right? Because banks are holding 8 times more treasuries than they did pre-crisis. Second, I do think treasuries reflect a convenience yield. In the LCR ratio, treasuries are at least 20% more valuable to a bank than the next best thing, RMBS. Of course, reserves at the Fed are also as equal. And in fact, you could argue maybe even a little more valuable than treasuries. But relative to RMBS, another kind of securities, treasuries are at least 20% more valuable. And so this is a good, a good that a bank wants. And as a result, you do have a special status for treasuries. All other things equal, the curve would be flatter than than it would be otherwise, I should say. And then third, at the margin, the liquidity coverage ratio should drive banks to put on riskier investments, all other things equal. So I want to make sure I'm very consistent with that, all other things equal. If you have a bank today that's earning its cost of capital, which I would argue is about 10 to 11%, I know there's been some discussion out there that it's less. I totally disagree with that, and a lot of investors I speak with do as well. 10 to 11% is the cost of equity for a G-SIFI bank. You can look it up, it's on Bloomberg. So that if you are if you are generating a 10 or 11% return on equity right now today, you're just delivering the cost of equity that shareholders want. So what does that mean? That means that if now you have a new rule, which is the LCR ratio, suddenly you have to allocate a little bit more towards treasuries. They're lower yielding than what you're making in return on other assets that you have, like loans, for example. And so as a result, if you want to keep that return on equity equal to what your cost of equity is, then you're going to have to barbell it, right? You're going to have to go out a little bit more on the duration risk or a little bit more on the credit risk to get that same ROE that your shareholders are looking for. And remember, banks and bank managements do have shareholders that they must address and must report to. That's a legal requirement, board of directors thing. So, for an example. So banks will have to invest in riskier assets. Now, look, you could come back to me and say, well, wait, what if a bank is earning 15% today and they're only having to earn 10 to 11? So can't they reduce their return on equity and get safer at the same time? Short answer is yes. So that's why I want to be clear of saying all other things equal. That's what it would imply. I wanted to add a couple of things to Professor Gorton's note as well. In our opinion, and this comes from speaking with some other folks in our organization, and we did put out a paper on liquidity back in the beginning of this year with many of my colleagues cross-border as well as in other departments within Morgan Stanley. So I kind of draw on that for some of my comments I want to make. There's a couple of other things I want to highlight in addition to what Professor Gorton said from some of the rules and regulations and some of the upcoming rules and regulations that we don't have out yet. We do see 4 additional sources of demand for treasuries, so it's not just LCR, which is making treasuries a greater good or a more valuable good for banks. Number 1, implementation of interbank derivatives clearing. Number 2, TLAC, which is the total loss absorbing capital rules, also known as the too big to fail rule. 3, money market fund reform, and 4, higher rates. Why do all these things drive more demand for treasuries? Well, let me tick through it briefly. 1, implementation of interbank derivatives clearing. Starting in September of 16, which is a little less than a year from now, dealers will be required to clear derivatives that they trade with other dealers. That will require them, the dealers, to post high-quality collateral at the clearinghouse, and treasuries are chief among them. Several tens of billions of dollars of incremental demand for treasuries coming. Second, TLAC rules. Total loss absorbing capital rules require banks to issue incremental senior debt, at the holdco level. And, the idea here is to have enough debt waiting in the wings in the event that there was a resolution event, or that's probably the wrong word I'm using, but an event where you needed to bail in incremental equity. So you have to have more debt in order to have enough potential equity. That's what I kind of call it. So all other things equal, that will also drive an increase in treasuries. Because if you think about a management team today, you're balancing your risk-weighted assets. How risky are your assets? You've got some lower risk assets, some higher risk assets. And if you have to issue debt, now you have to keep that balance aligned between the risky assets, the less risky assets. So as a result, you'll see another tens of billions of dollars of demand for treasuries. And you might be sitting here saying, who cares about tens of billions of dollars? Is that really, a marginal buyer of size for me to worry about treasury demand? Well, let's get to number 3, which is money market fund reform. Money market fund reform is kicking off, well, it's already kicked off, but it's going into effect October 2016, so a little less than a year from now. And one of the key things with money market fund reform is you have to decide as an investor in MMFs today, do I want a stable NAV or do I want a floating? And if I want a stable, I have to invest in government bonds. And right now today, there's 2.7 trillion of money market funds. 1.2 is currently in governments. 1.4 is what we call prime, so non-government. And we expect that some of that's going to be flowing into government. So we expect that retail, which is, $500 billion of prime money market funds, that not all of those people actually want floating NAV. They might want stable. So you'll see some incremental demand for treasuries there. Maybe that's a little bit more incremental than the first two. And then you have higher rates, which comes with some risk if there's any impact of higher risk on your flow of deposits. Because with the LCR, one of the things you have to do as a bank is say to yourself, well, what's the potential risk for an outflow of operating, non-operating deposits? And not to get too technical here, but if you assume wrong, you might have to buy some more treasuries to make up for that. And I think one of the things that all of this that I just went through indicated is there are other rules besides the LCR that are going to force an increase in demand for treasuries. There's also rules with multiple competing interests, I should say. And you can see that with the money market fund reform as well as the LCR. There's some competing interests there. You can see it in the common equity tier 1 ratio versus the SLR ratio versus the LCR ratio. And we have a few new rules coming as well, like the fundamental review of the trading book as well. Potentially, I hear it's coming. I don't know exactly, but supposedly it's coming. And the minimum requirement for the CCAR ratio for GSIBs, is that going to move up or not? So these are all very important rules that I do think has made the system safer. We do have to understand that there's some competing tendencies there, competing goals, I should say, within these rules, and it can force some unusual outcomes. For example, in the case where JPM recently decided to reduce its non-operating deposits to try to reduce its SIFI buffer and help out its SLR. And I say unusual, and maybe it was an intended consequence, I don't know, obviously, but maybe I say it is unusual because bank managements don't come to work every day looking to shrink, right? They come to work every day looking to grow, to drive profit for their shareholders, to do well with their clients, to give back to their communities. And so it's unusual to want to shrink, but that was a consequence of the rules that have been put in so far. And what I wanted to just end on was a comment around where those deposits went. So some of those non-operating deposits, yes, went to smaller banks. They don't always have the right products to serve. Some of them went to money market funds. Some of them went to treasuries. Professor Gorton's comments about how you had a zero yield in treasuries recently at a recent auction, I think was in part because you've got banks saying, we really need to be careful about how much in deposits we take onto our balance sheet. So, rules kind of driving a push of economic and financial activity towards shadow, could be an intended consequence, but it is something that is happening right now here today. So thank you for your time.
Okay, thank you. Thanks both. Let me just start and ask Gary, did you have anything you wanted to say in response to the...
No, I pretty much agree with all that.
Okay.
Other sources of demand for treasuries.
All right, so I'm going to ask a couple of questions, and then I'm going to open it up. Let me start with you, Gary. So I know you for a long time, so I know what you're getting at here. The whole point of your talk essentially is agnosticism, right? You're saying that when you make a regime change, other things are going to happen, and they're really hard to understand what they might be. But I was trying to, I think it might be worth speculating a little bit on the kinds of things that might happen that we should be looking out for. So, for example, in analogy to your deposit, your historical example, you could imagine if checking accounts backed by, or bank repo backed by treasuries are not economically efficient, that you might have, for example, more repo moving into shadow banking backed by credit securitizations, for example, or alternatively some substitute for repo with a similar structure. Is that the kind of thing that you're thinking about, or is there another example?
No, that's the kind of thing. It's some form of short-term debt that's going to be backed by some form of privately produced collateral. But I would also emphasize that in both the national banking period and the development of the shadow banking period, this happens over a long period of time. Mm-hmm. And because it happens over a long period of time, I think we tend to get sort of lulled to sleep. We don't actually know where to look. I think we know where to look now. The question is, are we going to know where to look in 20 years? And the other thing is, I do think this conceptual confusion is very important. The national banking era, it was very smart people, and they were confused about checks. And I think the confusion about repo, for example, contributes to this idea that we don't have to worry about the development of another shadow banking system.
So I guess to follow up, is this a counsel of despair? Because you said earlier that deposit insurance was implemented, yeah, which is clearly a regime change. Yeah. You sounded a little bit more favorable about that particular change. Given that we were very unhappy with the way the system was working in 2007, we had to do something. How would we think about the right regime change?
Well, I don't want to be too much of a pessimist, but I would point out that both the national banking era and deposit insurance were almost accidents of history. These were not by intelligent design. Economists opposed deposit insurance, and national banking was to finance the Civil War. So I think it's an intellectual problem and an educational problem to get to the point where we can, as a society, implement changes I think would be for the better. But the problem is banking crises don't happen often enough for us to really get momentum on that. So it's for example, I thought one of the most important things that we should have gotten out of the crisis was a new system of measurement. Not replacing things, but adding to it. And I wrote this paper with Brunermeyer and Krishnamurthy, and at the time I said to these guys, this is going to be the most important paper we ever write. And we tried really hard to make...
Important or impotent?
Well, important. But, and I thought, we would be able to get that because during the Great Depression, is when we got national income accounting started, right? So I was sort of hoping for that, but we didn't even get that. So I think there is a sense of overconfidence about the reforms that we have adopted. And I think the fact that things change so gradually is very dangerous for us. I'm not optimistic.
Humility is always a good idea.
Yeah.
Betsy, if I could ask you, you were talking about how the LCR would push banks into riskier investments. So in principle, assuming the binding constraint on the capital requirement is the risk-weighted assets and stress tests as opposed to the leverage ratio, assuming that's the case, in principle, obviously the risk weights might not be right and so on, but in principle, wouldn't that solve the problem because you need more capital for the riskier investments?
So yes, that's accurate, but you also are trying to triangulate to a certain ROE outcome. And as a result, if your RWA is your binding constraint, you have a little bit less wiggle room than if it's your SLR is your binding constraint. So to your point, it depends on which one is your binding constraint. And institutions kind of migrate between them. And at the same time, and that's, I guess, part of the challenge with all the different rules, at the same time, they're trying to triangulate as a goal to at least earn their cost of equity.
Okay, let me open it up. Steve Cicchetti. We have
the mic's next to me.
Mics, okay.
Fine, thanks very much. I guess I'm here to provide the Basel response. I'm Steve Cicchetti from Brandeis International Business School. So first of all, I think that that when we were designing the LCR, we thought about it more as a reserve requirement an analog than as a backing for demand deposits the way you said. So it's important to keep in mind that the rate of backing is is far below 1. So it's for standard retail deposits, it's 3%. So that really does reduce the amount that you need. I think it's also important to keep in mind that we wanted to try and make sure that central banks were the lenders of last resort for commercial banks, not the lenders of first resort for those banks. So a lot of what we've seen, I think, is in fact has been intended. And the reductions in ROE of banks that has come from this, that's what we were hoping for. And of course, I can't remember being more upset than the day that that one of the largest bankers, the CEO of one of the largest banks in the world, stood up in 2010 and said, I'm going to get an ROE of 13% for my banks. I said, well, this is ridiculous. I mean, the whole point here is to drive ROEs down into the realm where you have safer institutions. I'll also say that I think that there are plenty of treasuries out there. Reserves count for high-quality liquid assets. Treasuries count for high-quality liquid assets. And in jurisdictions where there aren't enough of either one of those, then central bank credit lines count for high-quality liquid assets. Finally, I'll just say that treasuries as a fraction of total assets in the banking system in the U.S. today is below where it was in about 2005. So it did go down, but it's way lower than it has been in the past. So I agree that we have to worry about unintended consequences, but it seems to me that the idea of liquidity regulation is something that we need, and we just have to figure out how to do it properly.
So this paper was written for the BIS annual conference, so I've heard from many BIS officials and so on, and they all say the same thing, like you. And I think you're kind of missing a few points. One is that, the Lucas critique is a serious thing. So I have an exact parallel. It didn't work out well. So quibbling over the numbers is not the point, right? I think you have to do better than that. I mean, I was told by the head of the BIS, he said, well, we had to do something.
I'll just make one quick comment.
Sure.
13%, I don't know if you're referring to JPM with their ROTCE goal, but their ROE is only 10. So a lot of bank managements speak to the ROTCE, the return on tangible equity, but in fact, the shareholders are buying the total equity. And
what if it's 7?
much
So
lower.
what?
It's too low.
Too low for what?
Too low for shareholders because, look, if I am a bank investor and I am going to recommend a bank stock to my CIO, I'm not just competing with banks historically over time. I'm competing right now today with what other investment opportunities are out there in the marketplace. And it's 10 to 11%. It's
But
not
Steve,
6 to 8.
you don't get to decide, what banks earn. You get to decide where banking is. Is it in shadow banking or is it in commercial banking? That's the decision you make, right? All these regulations, that's what you determine. You just determine where the banking system is.
What's the ROE, do you know, on utilities?
ROE is a little bit lower, but importantly, their yield is much higher. And one comment I would like to highlight is that there's 3 basic kinds of bank investor or stock investors. There's value, there's growth, and there's yield. So you don't really want banks to be value stocks, do you? I mean, because that's essentially what they were in 08.
I was asking the question about being utilities and having a lower ROE.
Well, but
Yeah.
they also come with a very high yield.
Mm-hmm.
So when we are not able to invest in bank stocks because the crisis is over, there's not as much value out there, and the yield is not there, utilities have 4, 5, 6% yields. A yield investor wants an S&P plus 100 basis points at least, and we're only yielding 2, 2.5. Then you're basically forcing management teams to listen to growth investors. And I'm not sure that that's necessarily what you're looking for as a regulator. Mm-hmm. I would think what you're looking for as a regulator is to have a shareholder base that is going to support the safety and soundness objectives of all the rules and regs, which really is your yield investor who's looking for stable, solid, slow book value growth, consistent dividend as well. So that's where 30% payout ratio is a little low for that.
Any other questions up here?
Sergey Kostev, Financial University, Moscow, Russia. I have a question. Can you provide some comparative perspective on the issue? How are things in Britain or Europe in general? Thanks.
I didn't understand the question.
How
So-
are things, is what Gary talked about true also among the European?
Ah,
Well, they're subject to the LCR also. So to that extent, yes.
could I just, real quick, you mentioned bank reserves. Does the BIS have a view on how big the Fed's balance sheet or a central bank balance sheet should be? No.
No.
But in principle, right, that's relevant to the supply of safe assets.
Okay, so I mean, I will tell you that in the discussions of the LCR, there was a lot of discussion about, which I think you were involved in some of, about the technical aspects of the interactions between operational monetary policy and the liquidity coverage ratio, and there the discussion was that there may have to be more reserves in the system, and that since those were interest bearing, you know, that would be fine. I mean, my own view, as I said, is that I think of these as like a reserve requirement. So in the same way that a reserve requirement can drive deposits out of the banking system because of the costs, and there, I mean, I agree with you, Gary, on that point, that it was possible that high quality liquid asset shortages could restrict the size of the commercial banking system, and that you had to be careful about that, and that you didn't want that to happen. And so my proposal at that point was that what we should do was adopt the Australian process, which is to have basically an elastic supply of high-quality liquid assets provided as an off-balance sheet item for central banks, and the price of those would create actually another policy instrument. But that's a sort of slightly different discussion.
No, but it is related. I think you're right. I mean, the thing is that, you know, in the period when we had deposit insurance protecting most of the privately produced debt, we didn't have, the central bank didn't have to worry about the quality of the bank collateral, right? It was a bank examination issue and so on. In this new system, the quality of the collateral out there matters a lot. And so open market operations, which trade one kind of money, treasuries, for another kind of money, cash, has an impact on, you know, the extent to which there's treasuries out there. So now, you know, and I think implicitly, and Ben can correct me on this, but I think the reverse repo program is eventually going to have to be the way the central bank can worry about whether there's enough high-quality collateral out there by changing that rate. Now, the question is that going to interrupt with, you know, sort of, you know, normal monetary policy? And I think there is no more normal monetary policy, right? There's just no going back.
Questions? Anyone else? Over here.
Thanks. Rodrigo Valderrama, Plantation International. With regard to the high use of Treasury notes to back up collateral for loans, don't you get into a chicken and egg situation where you really turn the banks into a public institution when they keep getting backed up by public money rather than just private money?
Well, the private money is the short-term debt that banks are going to issue, which has to be backed by treasuries, right? So if banks don't want to use all their treasuries for that purpose, then we're going to see short-term debt appear somewhere else. You know, that's sort of the issue. And again, I would say it's an issue over, say, 40 years, not, you know, next year. But I would just add one other thing about this demand for safe assets, because we both mentioned the Treasury auction. I mean, I think one reason there's no inflation is because everybody wants to buy safe assets. You have no money multiplier. We're stuck in this world where, you know, everybody wants treasuries. They bid on treasuries. This is Caballero and Fardy's point, not mine.
Over here.
Ted Murphy from CRS. Just a quick piece of bank history trivia that might play into whether or not things are in banking or shadow banking. I believe that the Bank of England had a monopoly on banking issued by Parliament, and then in the rise of deposit-funded banks in the 1800s, that was the Bank of England tried to enforce its monopoly, and Parliament said, no, you're a bank. They're deposit-taking institutions. So where I'm going with that is to accept your premise that we change the rules on what we're calling the regulations, and then if we start thinking who else and how else could someone who's not what we're calling a bank today fund the same kinds of activities that you're bringing up that we need to think about in the shadow banking system. So someone in 1835 in England could have imagined someone can fund the kinds of things the Bank of England does by accepting deposits and then think, oh, we need to do things with deposit regulation. You're bringing up a good point. What kinds of things can we anticipate? Who could arrange a set of contracts similar to what you're bringing up?
I think it's very difficult to anticipate it. I mean, I think it's, it's a matter of horizon. And again, we didn't do anything about measurement. So right now, I think everybody's kind of overconfident, but that's because they have short horizon. I think, I mean, who knows? You could issue dollar-denominated bearer instruments in China. Who knows? I don't know.
Bobby Pestron, just a citizen. Addressed to each of the speakers, what should the layperson in the United States who is concerned about the effects of the last recession and the issues that you've been discussing today, what should he or she be thinking about relative to what government and the private sector should be doing to prevent another disaster like the one we've just been through?
Well, I don't want to be too pessimistic again, but let me tell you some American history. By the way, you don't have to say just a citizen. A citizen is good enough. No, financial crises are the norm in the United States and in other market economies. It's not, the period that was very unusual in the United States was from 1934 to 2007. That was the unusual period, right? It's harder to explain that than it is to explain crises. So in all these crises, the same thing happened. You have a big crisis, you get this massive blowback against bankers, some legislation is passed, and 7 to 10 years later is another big crisis. And it takes a while, I think because of the infrequency, for ideas to kind of seep into, consciousness. I mean, deposit insurance, we had tried in some states before the U.S. Civil War. Some states tried it in the early 1900s. But those were on the state level, and it became a sort of populist mandate before deposit insurance was passed. So I think ideas for reform just take a while before they sink in. I mean, I propose some things about reform, but I mean that's what we observe. I somehow just don't see this time as being any different. We pass some stuff, maybe some of it's good, it doesn't address the fundamental problem. We're kind of confused, off we go, and there'll be another crisis. I mean, I mean, if you think, I think the other point of view is the one Steve was pushing, which is, this time is different, and, we don't pay attention to history, right?
I think the summary is if you modify a complicated system, you have to be careful of unintended consequences.
Yeah.
Any last words?
I think we've done a great job.
Excellent. Okay, we'll stop here. Thank you.
Thanks, Ben. I'm gonna rush out at 5, so if I don't see you. Thanks for having me.
Sure thing. Take off your...
Yeah, leave the mics. Good afternoon. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings, and I want to add my welcome to that of Ben Bernanke. If I had heard Gary speak before we had framed this event, I would have framed it as, how can we make sure that no Yale professors will stand up here in 2115 and say, how could they have been so stupid back in 2015? So that's my new goal, is to help identify those things that we're doing today that the next generation will deride as stupid. I think we should avoid those. One of the big changes in the financial system as a result of the crisis has been some changes in the way the Treasury bond market works, and there have been frequent assertions that there's less liquidity in the bond market and that will lead to the unintended consequences of the sort that Gary Gorton has been warning us about. So we're going to turn to that now. We're very fortunate to have a presentation by Darrell Duffy, who I learned by reading his bio, started his career in civil engineering and then moved to financial engineering. Darrell's been teaching at the Stanford Business School since 1984, and we're particularly grateful for him joining us here today because he's actually on sabbatical in Switzerland and made a trip here just for this event, for which we're very grateful. He'll be followed by two discussants. One is Victoria Ivashina, who has been teaching MBAs finance at the Harvard Business School since 2006. And the other is Nellie Lang, who has been at the Fed since 1986 and was designated by Ben Bernanke to make sure that we never have another financial crisis. Is that right? Do I have it right? That's not quite the way the job description reads, but she's now the Director of Financial Stability Policy at the Fed, which is an innovation meant to help us so that we don't at least get smashed in the face by something that we didn't see coming. I want to make one point here. The Federal Reserve ethics lawyers are very strict, and I promised them that there would be at no time would Ben Bernanke be on the stage at the same time as Nellie Lang or Dan Tarullo. So I have never worked for the Federal Reserve, I never will work for the Federal Reserve, and I never intend to seek an ethics opinion from the Federal Reserve, so I'm free to do that. We're going to start with Darrell Duffy for 18 minutes, then Nellie and Victoria will come up, and then we'll, as we did before, have a little discussion and invite you to join us. So, Darrell?
Thanks very much, David. It's good to see you all again. So I'm not quite as pessimistic as Gary. I do think we've done something to improve financial stability. But the question is, and there's been a constant drumbeat of questions, has that changed bond market liquidity in a significant way? So if you follow the Financial Times or Bloomberg, or even more popular press like New York Times, is just almost every day there's something. Often, of course, it's a bank that says the regulations have gone too far and bond market liquidity has been very severely impaired, but even others have said so. What I'd like to do is to take everyone through a quick tour of how that might happen and whether there's evidence that it has happened. So first of all, how it might have happened. I'll just go briefly through the list of possible channels by which changes in regulation might have caused a deterioration or a change, at least, in bond market liquidity. The first one is sometimes called agency intermediation, which means that when a bank is subjected to higher capital requirements, and I work for a bank broker-dealer, and therefore I'm subjected to those capital requirements. Gary calls me and says he wants to sell a $50 million corporate bond position. Before the new capital requirements, I might have said, sure, here's my bid and ask. Now I'm more likely to say than I was before, hang on a second, Gary, I'm going to go look for buyers for your position, and I'll act as an agent effectively for your trade. And when I get a buyer, maybe David, I'll get 10 million, then I'll look for buyers for the other 40 million, and over the next few days, we'll work down your order. So that's called agency intermediation. That's one way that Gary might get less immediacy for his trade demands than before. Another way that it might happen is that central counterparties can come into play. So this time, if I have long and short swap positions of, say, 100 million with two different counterparties, that's a lot of regulatory capital. One way I might deal with that problem is to take the long position, send it to a central counterparty, take the short position, send it to the same central counterparty. The long cancels against the short, and now I don't have a large position against which I need to hold regulatory capital. So there's going to be more incentive to move positions into CCPs. And that's already happened in the swap market, and there's a lot of movement in the United States to have that happen in the bond market as well, particularly for repos. The next thing that might happen is that the bonds won't be handled by banks at all. They'll be handled by all-to-all trade on electronic trading platforms like BrokerTech, MarketAxess, Bloomberg, TradeWeb, where ultimate investor meets ultimate investor directly and anonymously in a central limit order book. So the banks are basically being disintermediated by that. In the bond market, there's a lot of that in treasuries, not so much in the corporate bond market, but it is growing from a low base. Another thing that I might do is to shift from, and this is something that, reflecting something that Betsy said, I might shift from intermediating low-risk products where my profit margins can't be high enough to overcome the regulatory capital to higher-risk products. And Ben alluded to the fact that if you have risk-weighted capital that's appropriate, then that shouldn't be a problem. However, we have, and Ben alluded to that as well, an additional capital requirement called the supplementary leverage ratio, which doesn't distinguish between high-risk and low-risk assets. And I'll get on in a few minutes to whether or not there may be implications there. And then another potential is that, and again, this is reminiscent of what Gary said, there could be some shadow bank intermediation, or maybe we should call it shadow broker-dealer intermediation, where a broker-dealer that's not affiliated with the bank and therefore is not subjected to these new financial stability requirements could step in. And that could be a good thing because it's farther from the core of the financial system, or it might be a bad thing if it's not well regulated. My overall message, the usual measures of liquidity look pretty darn good considering how much change there's been in this last round of financial reform. That is, in my view, we've gotten a lot of financial stability, and so far there's not that much sign of serious problems with bond market liquidity. I'll give you one or two exceptions to that, but overall it's kind of surprising that we've done as well as we have considering all the changes that have been made. Now, the whole story is still playing out because, as everyone knows, it won't be long before interest rate policy at the central bank starts to normalize. We'll see more bond market volatility that has good effects and bad effects. Good effect is when there's more changes in prices, people have more reasons to trade, and liquidity will improve from just simply more reasons to trade. There'll be more activity in markets. The bad effect is we'll find out whether, with all of these changes, the market can handle some of the sudden rushes for exits that are going to occur as people who are used to holding bonds that trade at very low yields to trading bonds whose yields are jumping around a lot more. Here comes my quick tour of what we're actually seeing in bond market liquidity. Except for a short period during the financial crisis, remarkably stable, low bid-ask spreads in the Treasury market across all of the main benchmark issues, the 2 years, the 5 years, and the 10 years. By the way, that spike is interesting because it says when shocks occur, shouldn't think of Treasuries as immune from changes in liquidity. And that is important because if liquidity in Treasuries goes down, a major shock could mean that Treasuries won't be the same kind of liquid safe haven that they've always been felt to be in the past. What about price impacts, meaning how much does the price of Treasuries change when there's a sudden trade? It varies a lot over time. It's not obviously much worse than it's been in the past. It's a little bit higher now. And there's been a lot made of the recent increases in price impacts, but I wouldn't say this is a disaster. Where do we see potential problems with bond market liquidity? Well, turnover is generally down, both in the Treasuries market, the corporate market, municipal bond market. The number of bonds going through the market on a given day as a fraction of the outstanding supply of those bonds is dramatically, I would say, lower. I'll give you some examples in a minute. What that means is that if you have to get a very large position through the market, you're going to have to be more patient. What else do we see that might be a concern? The derivatives markets that are used to hedge bond markets are changing significantly. The one that I would like to single out is the single name credit default swap market. Not a highly popular security in the narrative of the financial crisis, but nevertheless an important way to handle risk in corporate bond markets. That market is really suffering in terms of the amount of activity that is occurring. It's getting less useful as a source of hedging for the corporate bond market and as a source of price discovery. And the one that I promised to come back to that's being impinged upon by the supplementary leverage ratio is the Treasury repo market, where I'll give you an example. Treasury market turnover is significantly down, and the amount of repo trading of treasuries between dealers is very substantially down. This is from a slide prepared by Antoine Martin of the Federal Reserve Bank of New York, which, by the way, has done a lot of good work on bond market liquidity over the last month. Go see their website and the Liberty Street blog. So why is this happening? It's, again, because Treasury repo, let's say I have a $100 million Treasury repo position. This is a fully collateralized, over-collateralized by U.S. Treasuries. It's a very safe position. But the amount of regulatory capital I would have to apply to that position is exactly the same as if it were a real estate loan. Because of that, I'd rather make real estate loans because they have a wider profit margin, so I'm declining to use my balance sheet to provide intermediation to the repo market. Another way to look at that is that if you try to borrow money in the using treasuries as collateral for 1 month, you're now going to pay higher interest rate than you would if you borrowed as a bank in the unsecured borrowing market. About 10 basis points, I looked at it yesterday. Let me repeat that because it's quite a remarkable change. Again, if you want to enter the repo market and borrow money collateralized by treasuries, you're going to pay higher interest rate than a bank would pay if it borrowed without any collateral. And you might ask, how is that possible? It's partly because the repo trades have to leap onto bank balance sheets to arbitrage that difference, and the banks don't want to have those trades come onto their balance sheets, at least not nearly as much as they did. Treasury futures trade sizes are down. Why is that? It's a lot of these changes are related to the fact that as broker-dealers affiliated with banks pull back somewhat from the market, the best bids and offers are being done by high-frequency traders on electronic platforms, whether it's at the Chicago Mercantile Exchange or at interdealer broker trade platforms like BrokerTech. About 80%, it was suggested, of trades recently in BrokerTech are high frequency, and that's the largest limit order book market for treasuries. What about the corporate bond market? Again, the story is quite benign with respect to bid-ask spreads. The market looks quite good in terms of how much it costs you to trade small sizes. But trade sizes are down. So the tendency to try to push a large position through the market in a short time that we had before the financial crisis has changed to one in which we want to put smaller positions in order to get better price execution. By the way, this is not necessarily a sign that there's too little liquidity. It may be the case that there was too much liquidity before the financial crisis. It's also the case that this is not all induced by financial reform. There was already, well before the financial crisis, a movement towards high-frequency trading, all-to-all trading in the treasuries market, and a increased price transparency in markets through things called TRACE, or trade reporting, post-trade price reporting, that caused dealers to earn less profits in this market and provide less of their balance sheet to trading these bonds. So this is there are more trends at work here. And again, I already mentioned monetary policy. Turnover in the corporate and municipal bond market is down quite substantially. Again, this is the fraction of the outstanding supply that goes through the market on a given day. This is a sign that if you have all-to-all trading, that is, there's many competitors for your trade on a bond trading platform, then your costs go down, bid-ask spreads narrow, and dealer profit margins go down at the same time. What does that mean? That dealers are going to be less anxious to try to earn profits by participating in this market than they were before. So they're going to provide less liquidity to the market. That's not necessarily a bad thing, but it's just a sign that the market depth is probably not going to be what it was once before. I already mentioned the decline in the single-name CDS market. I'm going to move beyond that and turn to my last issue, which is one of the concerns that's been raised about the reduced balance sheets of the broker-dealers, the bank-affiliated broker-dealers in the bond market. Where do the bonds go, and what are the implications for that? This chart illustrates that where broker-dealers affiliated with banks were building up large positions before the financial crisis, the new bonds coming into the market are more and more being held by bond funds, ETFs, and mutual funds that own treasuries, corporate bonds, emerging market bonds, and the like. Some have suggested that that's a source of financial instability, because when there's a rush for the exits by mutual fund investors, who's going to catch these falling bonds? Will that cause, let's say, a fire sale or someone to topple over? I'm actually much more sanguine about that possibility than others, but it is a possibility to keep one's eye on. This is net monthly cash inflows to bond funds, and you can see at certain times, like during a so-called taper tantrum, you get very large flows out of bond funds in a very short period of time. This slide is from the Joint Staff Report on the U.S. Treasury market, showing that, again, volatility of flows in and out of bond funds is much higher recently than it was before. Again, when these big flows occur, will that cause a problem? The mutual funds themselves are not levered investors. Their investors may suffer some additional volatility in the value of their investments. The market value of their positions may go down quickly, and they may lose money if they try to sell immediately before the prices recover from the price impacts. But I myself am much, as I said, more sanguine about the likelihood that this would generate a financial crisis. Who, after all, is going to, as I indicate on this narrative, who, after all, is going to fail in terms of a systemically important financial institution? Not the banks, because the whole point of this exercise is that the banks are now much safer. They're not in the firing line. They're not large holders of these bonds. If you wanted to look for a potentially vulnerable victim of a fire sale in this market, where would you look? Maybe asset managers, but I don't think so. They themselves are not the investors, and they have a very wide, diversified set of clienteles doing a wide range of trading strategies. Maybe the alternative asset managers, like hedge funds. Now, that's a place where I would tend to focus a little bit more attention, because they're large, levered investors. The number of extremely large hedge funds has grown dramatically. There are advantages to limited partners for getting out of those hedge funds quickly when they see trouble coming. And the portfolio managers that are the experts handling those positions, once they see that their employer is having difficulty, would themselves have an incentive to move. So that's a potential source of financial instability that I think we could pay more attention to. There's been increased focus by regulators on other large financial institutions like insurance firms that have exposure to changes in fixed income markets. And we may hear more about that later today, I hope. And Betsy already mentioned what's happening in the money market space, and I think that's something that's also playing out. So overall conclusion, it's too early to say. I'll just finish there. Thank you.
Like this is me? No? Okay, so my slides are not here. Okay, so let me just start this. I think that in the big picture, Darrell is absolutely right in I have a copy of my slides. Daryl was absolutely right in that it's too early to draw conclusions. The evidence that we have is not sufficient for us to start worrying, which is not to say that we have evidence that leads us that we should not worry, right? And there were many changes, structural changes out there, and so it's very hard to connect specific things. It's very hard to say, well, the dealers hold less inventory, and therefore that's the cause of liquidity. Actually, there is a long list, and Daryl pointed it out, that leads to the fact that liquidity had changed. And so it's a natural place to start here is to say, let's measure liquidity. And so Daryl took you through the tour of let's look at the liquidity and let's think about whether the average behavior of the average liquidity in the past few years are indicative of something that we should worry about. So a good place to start here is treasuries, right? And so there we can go several measures. We can look at transaction cost, we can look at turnover, we can look at the depth of the market, we can look at the transaction size, we can look at the price impact. And on some measures there is no impact, or at least not if you plot it on a magnitude as compared to 2008. And so on other measures, but on the most measures, I think the conclusion is the fact that there are spikes, and they're large spikes, not magnitude of 2008, but they are rare. And even if we look at the events as October of 2014, there is a big spike, but it quickly disappears, and so everything settles down. So that's on the side of treasuries. So we have a very rich insight into liquidity on treasuries. Then we go into corporate bonds. On the corporate bonds, the picture is very similar. So there we start the measures of liquidity are less, and so because the market starts to get more liquid, and so on transaction costs, we still can measure it quite accurately, at least for corporate bonds as a general bucket. And so on the transaction cost, nothing happening much. Turnover declining, but the outstanding increase, so not that much. Transaction size is declining. So that's the evidence that we have. Overall, the magnitudes are not that dramatic. There are spikes, but they are rare and they disappear very quickly. That's the evidence. Now, the point that I want to raise is the fact that that's great, but we are measuring it where we can, as opposed where we would like to. And not to say that I don't have an answer to. Nobody can measure what we would like to measure, so we're just looking at what we have. And so the first point is that we would like to measure risk. And when we're looking at the average liquidity, it's not an indicator for what will happen if there is a tail risk, if the dramatic drop in liquidity is possible or not. And Daryl raised the point and that was the second point that he did towards the end of his presentation, that thinking about market structure and asking yourself question as who exactly will fail, because it's not the mutual funds. Who exactly will fail and what forces escalate this into a broad financial stability crisis? That's where we should be thinking, the way we should be thinking about it. Now, the other point is that what should we exactly be measuring? And so treasuries is one of the most liquid asset classes. This is a $13 trillion market. It's much more liquid than the corporate bonds. It's less dependent on warehousing. It's a money-like securities that was brought up in the first section. And so then when we think about can we extrapolate from treasuries into corporate bonds, the answer is not quite. Another point is that in the corporate bonds, actually, there are many other buckets. And corporate bonds is this catch-all category, but there are these securities, there is very little standardization there. And so even at the highest level, investment grade, high yield bonds and leveraged loans, which is a form of bond, very close to bonds, have very different liquidity. So what I want to add to Daryl's presentation, although not with dramatically different conclusions, is bringing an asset class that is within this range of fixed income that stands out as by being on the opposite extreme of the treasuries. So treasuries is one of the most liquid. If you're going to look at the spectrum of the fixed income, leveraged loans is something that is extremely liquid. Now, it has loans in the name, which is why it might be often left out of the conversation. But actually, it's a syndicated loan. It's a high yield, often rated loan product that is originated by banks, but held by institutions. And so this is a much less standardized than bonds. I think I get more time because my slides were not uploaded. Just joking, I don't need it. I need to communicate points that otherwise would have been communicated on the slide. So it's a much less, so loans are even less standardized than bonds. If you want a space for reaching for yield, loans will be the ideal space where you can reach for yield because the contracts are just extremely long and there are many ways of making the contract looser and get an extra yield for something you barely understand. It's much less liquid than bonds. Forget treasuries. It's much less liquid than bonds. It takes 10 days in the best case scenarios to settle your transaction. It's now, it is a variable rate product as opposed to a bond, and so in terms of monetary policy, it will be reacting to different things. But here are a few things to mention. It might be left out of, another reason why it might be left out of a conversation that as compared to to corporate bonds, leveraged loans, high yield loans that are sold to institutional investors are relatively small. All that said, it's a nearly $2 trillion market. And if you look at the post-crisis issuance of high-yield bonds versus high-yield loans, actually high-yield loans was much higher almost every single quarter. So, and it is not surprising that it's in the high-yield loan space that the mutual funds, the same points that we brought in before. So one of the concerns is that there was a large growth in high-yield mutual funds. And it's in the loan space, in the high-yield loan space, that's where it grew the most. So it goes from 20 billion towards its peak to nearly 170 billion, so it grew 8 times. And so it's a rich area for thinking about what will happen if the mutual funds start to redeem. I'm all set at this point. So, and another observation, so Darryl showed you the flows in and out of treasury mutual funds, in and out of corporate bond mutual funds. But now if we clean and add precision to that and specifically zoom on this asset class, leveraged loans, the flows actually, they start to deteriorate in 2014. Of course, in November 2014 is, October and November 2014 is a big event in this market. That's also where it hits the bottom. Now, I wish I could show it to you, but that's a market where the mutual fund space grew by times, but it also been declining most dramatically, and it's been declining for 6 quarters by now, which I think this is a nice space to think about. If those mutual funds will run, what will be the consequences? Because we don't observe that one quarter it's oops, it's all bad, oops, it's all okay. So here you see several quarters of bad environment for mutual funds and several quarters of withdrawal from mutual funds, which to me leads to think that if this would be run, there would be an indication of, if this would be an environment prone to run, this would be an indication by now that there's something would show up. Now, on the left, so going back to liquidity, we started with, we can measure liquidity for treasuries very well, corporate bonds, very similar conclusions if you look at it as a bucket. But the graphs that Darryl was showing in his tour actually were at an annual frequency. And one of the conclusions about liquidity post-crisis is that it's very short, that the volatility is actually much higher in the shorter horizons. So for treasuries, for example, the intraday volatility, the spikes are much higher. And so if we zoom in on what happens to liquidity in this segment, in the leveraged loan market, you observe that actually there is a spike in 2014 exactly where we expected, but it doesn't disappear afterward. It comes down, but then for the past half a year, it's been going up. So the cost on trading in the leveraged loan market is going up in parallel with observations that I made that mutual funds actually continue withdrawing. Turnover, the drop in the third quarter of 2015 is 10%, the drop in the second quarter of 2015 is 3%. So there is a continuous decline in turnover. But all in all, these are relatively gradual deterioration, which is not something that we envision as a run. Now, the final point is the point that Darryl raised. So, all right, so we have to ask ourselves, though, given that these liquidity observations, who exactly would fail? What are the accelerating forces that would lead us to hit the bottom? Think about 2008. In the leveraged loan index, late 2007, trading in 95s, exactly where we are right now. And then in the fall of 2008, it falls to 60. From that levels of 90s, it goes to 60. So what could bring us from this 90s area to 60s? And so there we need to ask ourselves, what is the composition of this, who holds these loans? And important buckets to identify here are threefold. One is CLOs, collateralized loan obligations. The second one is, of course, mutual funds, which had grown in this market. And the third one is banks. Now, banks actually have been shrinking a lot, and this is resulting partly from this new macroprudential pressure from the Fed, because under the new leverage loan guidance, this is precisely the asset class that is get targeted, and banks are very cautious on how much engagement they have in that layer. So banks have little on their balance sheet, even though they are the ones who drive this market. The CLOs, much bigger share, mutual funds also increased. What compressed? So I named the three things. Well, the thing that compressed is hedge funds, which is what Daryl said. Look for the leverage. You need leverage structures. And actually what squeezed out in the market was the leverage structures. There are some other agents, but they do not have leverage in the structure. And so what to bring you from 90s to 60, you need to identify the accelerating force. And that the starting point is mutual funds, but you also need an extra layer as to who will be forced to sell off in this market. Now, I need to point out that CLOs and mutual funds, mutual funds, as well as these new structures that emerged as that took place of the hedge funds, they are all market driven, right? So only the banks are regulated. CLOs, there is a risk retention rule, but this is largely shadow banking. And so these are all market level disciplines. And I'm going to bring back Gary's point, and that we are under the illusion that these things we shouldn't be under the illusion that these things will evolve very gradually. And so we should keep an eye on the monitoring liquidity, with understanding that by looking at the average liquidity, we are not assessing the tail risk. And we should keep an eye on the structures of the market and understanding that those structures are market driven and they can deteriorate over a medium horizon. Thank you very much.
How do I get it up on the screen? Okay, let me start by saying thank you for the invitation to be here today. And I have to start by saying these are my views and not those of the Federal Reserve Board or its staff. Thank you. So I'm going to start also like Victoria, where I largely agree with Daryl's assessment on market liquidity. Changes are occurring. Effects are still playing out. Moreover, if there were some dips in market liquidity where even less liquidity could amplify risks, it may be coming at the benefit of a more stable financial system. Since I agree, I'm just going to try to add to the discussion a bit today and bring some additional points by focusing in particular on the interactions of dealer market making and the increased role of investment funds or asset management. To emphasize a few points up front, I would say first, there have been important structural changes in fixed income markets that preceded the crisis. In the corporate bond market, the TRACE system, which Daryl mentioned, the trading, reporting, and compliance system, was introduced in 2002, required timely disclosures in 2005. And then we've had the growth of proprietary automated trading in some markets, which had started in equities and FX and have now moved to parts of the treasury market. And these kinds of developments have definitely removed the sort of the information advantages that dealers have always had. Since the crisis, dealer market making has been reduced, and I would argue both because of their own risk management practices and from regulations, an intended consequence. Low returns, low interest rates may also be a factor. And then finally, in addition, the increase since the crisis, the growth of credit provided by mutual funds has grown substantially, which I will show you. In principle, this shift in credit intermediation is stability enhancing. These entities are much less levered. However, there seems to be concerns that they may face spikes in redemptions, and combined with market liquidity could amplify price declines. Okay, so I'll start with two slides here, which are going to show, which I will use to show that the financial sector is more resilient. Gary may say I'm being short-sighted, but let me just point to this. This is credit market debt as a share of GDP, and it's shown by the type of financial intermediary that's providing the credit. The dark blue at the bottom are banks as a share of GDP. That's been steady for decades, starting in the 60s. Insurance companies right above that, and pension funds also pretty stable. And then in pink, you can see that's the GSEs. So that started to become a big part of the system in the 2000s. At the same time as the GSEs, then I would call the areas between the light blue and orange as shadow banking. This includes your finance companies, your broker-dealers, your asset-backed securitizations, your money market funds, et cetera. And these grew rapidly since the mid-'80s, but especially in the lead-up to the crisis. These have contracted sharply. And then finally, yellow is the growth of the mutual funds since the crisis. And since the crisis, it's really the only group that's been gaining share. Okay, second slide is just a different way to think about the system, which is the whole financial system relies a lot less on short-term wholesale funding than it used to. This is a chart of aggregate short-term funds, which includes repo, sec lending, money market funds, CP, et cetera. It's lower in the years just preceding the crisis. The recent rise is the expiration of the transaction account guarantee, the insured deposits up to $250. So again, in principle, financial stability would be enhanced when risk shifts from firms that are more leveraged and more stable funding. Okay, so turning a little bit closer to market liquidity, this is another change in the system. These are dealers, and this is positions in different kinds of debt securities. The right-hand side, dealers are holding fewer securities in inventory. This is what the press picks up quite a bit. They make it suggest that that means if they hold less inventories, they are doing less market making. This is in aggregate, and you can see in the past few years it's fallen. But on a net position, it's a little lower. It's back to levels around 2007. On the right-hand side, this chart here is just to kind of illustrate there's a lot going on behind net aggregate positions. Corporate debt inventories, the red line, has been about flat for the last few years, maybe shaded down a little bit. And the recent declines have really been in treasuries, and that's the black line. And there's a pretty significant negative correlation between these two, since dealers use treasuries to fund their corporate positions. Perhaps the more interesting point here is we don't tend to view that these net positions are a very good indicator of dealers' willingness to make markets. You can look at the positions in 2007 and 2008, large positions, and would argue that this did not at all signify a greater willingness to make markets once prices started to fall. So I think we have this unresolved issue, which is you can have high inventories, perhaps with the high leverage, or you could have low inventories and low leverage, and which ones will generate more market making is still an open question. And then here, I'll go through this quickly. This is just two indicators of market liquidity in the corporate bond market. I'll make 2 points here. First, this market's never been very liquid. It's probably not liquid now. It wasn't liquid before. That's like a key point. If you look at bid-ask spreads, that's like 100 basis points, versus treasuries, which are like 2 or 3. So they're pretty high. And then the share of trades that are greater than $1 million, 10 or 20 million. This is from the Trace system. I guess the second point is these trends don't show any correlation with the changes in net positions of corporate bonds. Okay, so one possibility for why market participants seem to be quite concerned, and it's this possibility that you could get a spike in the demand for liquidity, and dealers are not going to be able to provide that liquidity. That's what is the concern. So here, I would say we do have growth of mutual funds, clearly sharp rise. The right-hand chart shows I'm going to focus on high-yield bonds because those are not that liquid. High-yield bond market size has been growing pretty rapidly over the past few years. The bond mutual funds, that blue line, have grown also. And as a share, they've picked up because they're growing quite a bit faster. Mutual funds, though, have been around for a long time. In 1940, for 75 years, they haven't notably contributed to systemic risk. But they are becoming a bit more specialized, and they are becoming bigger players in these less liquid markets, and that seems to be generating some concerns. So two things a couple areas why funds might cause problems. First, and the SEC is looking at this as well as the Financial Stability Oversight Council. What was a very simple intermediation chain has gotten a little bit more complex. First is this move to less liquid assets. So there's a fundamental mismatch between the on-demand redemption of mutual funds and the kinds of securities that they're holding. There's also a first mover problem in the way the U.S. mutual funds are structured. Funds mutualize the cost of asset liquidations, and so these costs are borne largely by the remaining shareholders. So combined with liquidity mismatch, this creates an incentive for investors to get out ahead of the other. This is your kind of run, although you wouldn't kind of put it in the same category as a run, like a bank run kind of thing, like a diamond dip big run. So nonetheless, these could amplify the effects of redemptions and greater asset sales. And then the potential of these mutual funds and reduced liquidity could certainly amplify any kind of credit cycle. So I just wanted to wrap up by just mentioning a couple things that the SEC is working on. So the SEC is taking a fresh look at the fund industry. The 1940 Act was 75 years ago. Liquidity risk management is one of 5 initiatives. So the proposal they issued in September tries to address a couple of important things that I highlighted. One is, how do they do liquidity risk management when the fund is investing in illiquid assets? And 2, can it help to remove this first mover advantage? So there's a number of things to do on liquidity risk management. They are asking funds to report assets by liquidity buckets and disclose more frequently. They're asking for 3-day liquid asset minimums. Gary will hate this. This will be so you have to hold at least 3 days. Board oversight of liquidity risk management programs, and greater disclosure. There's also an option for swing pricing, which is a feature of mutual funds that is adopted in Europe, where a fund can anticipate in large outflows the effect on the net asset value. So you can swing down if you're expecting large redemptions. It's been adopted in other places, so it's possible here. And then, and so more broadly, besides this illiquid assets, mutual fund intermediation has gotten more complex. Funds can use derivatives, and they engage in sec lending. These are 2 ways that are just kind of leverage returns, and so the SEC is planning proposals on stress testing and the leverage. The Financial Stability Oversight Council is also reviewing these issues. In practice, it's possible that any regulations aimed at individual funds may not be sufficient for systemic risk. For example, would they capture correlation risk versus idiosyncratic risks? Or would stress testing of funds capture that you're likely to have funds, redemptions at multiple funds, not just at one fund? So I think the goal for these financial stability reviews is to assess the structure of the intermediary, not to regulate asset prices or moderate asset prices. And it'll be work in progress for the next year or so. Okay, thank you.
For that, and I apologize to Victoria. So her slides will be on the Hutchins Center website at brookings.edu, and I personally will mail a full color copy of her slides to anybody who's desperate to have them. So I thank you for being such a good trooper. It seems I'm always a little bit overwhelmed by these discussions because on one hand, you hear the industry saying that these guys in Washington and Basel, and they're mostly guys, don't know what they're doing. Gary's got it exactly right. They don't really understand how the markets work, and they are going to make things worse when we have another crisis. And on the other side, you have people saying, some of the complaints of the industry give me a headache. They're saying that we can't do everything we could do before the crisis. And then you say to them, yes, that was the point. We didn't want you to do all that stuff. We didn't want so much leverage. We didn't think that anybody being able to trade anything, any moment, was necessarily good for the society. So we're caught in this tension, and I want to tease out a little bit about how that fits in this conversation. So in our attempt to get a diversity of views on the stage, I don't think we didn't represent the people in the industry who are most worried, and so I'm going to try and channel what, as best I can understand, is the industry argument. And I think what they're saying is, you all are too complacent, that we haven't tested anything yet. We've had an extraordinary period of very low interest rates that we know is abnormal, and we've had a couple of minor shocks, but what makes you so confident that if there was something that happened and there was a big spike in prices in the bond market, that some big bank would actually come in and be willing to buy them, which is what we need to keep the system stable? What makes you so sure?
Thanks, David. Well, I think my last remark was it's too early to tell. I think that is a risk. On the other hand, a lot of people on the buy side would say, well, they never came in big to supply liquidity to the market during a stress period. Of course, it's all relative. If they have the ability to supply some significant amount of liquidity, that's good. But I do think it's too early to tell. We may have some air pockets. The question, though, is when it happens, and it probably will, how will that shock get transmitted to create financial instability? And I think you heard both Victoria and Nellie say, look to the bond funds or look to the leveraged loan funds to see they're not going to fail, the banks are not going to fail. Who's in the next tier?
So is that a good thing that we've moved the risk to the leveraged loan funds and the bond funds because they're less systemic? Is that basically the argument?
Well, Darrell in his slides, I don't know if it made it to the final version, had this point about who exactly would fail. And mutual funds cannot fail by definition, and so you can kind of have needs a chain of accelerating forces. And so I do agree that moving off the balance sheet of the banks is an important point. And just to echo Darrell's point about the starting argument about the banks coming in and providing liquidity into the market, that's not what we have seen during the past crisis. And there is actually a piece of research with very micro data from Bundesbank in Germany, where they actually look at who's buying what, and they illustrate the fact that there is not much role of a bank as a provider of liquidity in that
Right,
context.
so we don't have to worry of them not doing it in the future because they didn't do it in the past. But let me just push you a little bit on this mutual fund thing. A mutual fund doesn't have to fail to cause a problem. If we have, as Nellie pointed out, lots of mutual funds who have similar portfolios, and they all try and sell at once, and it turns out some of their stuff is illiquid, so they sell all the liquid stuff at once, then you could get the fire sale bad dynamic that we know is a problem. So it's not good enough to say a mutual fund can't fail.
So I think you raised the point about whether the mutual fund could amplify any kind of price decline, and I think this mismatch and the first mover advantage has that potential. So having regulators look at that and try to fix that seems like very on point. I think the other thing to mention is there are going to be bond losses. People will take losses. Prices are going to fall, and so I think you want to make sure your intermediaries, the funds or whatever kind of institution, don't amplify those and make them become a bigger problem. If it's just a liquidity issue, it could mean, so it takes me 3 days to execute a trade versus 1 day. If it doesn't actually permanently alter the prices, it's not
Right.
as much
So
of
the
an
whole
issue.
purpose of finance is to mobilize savings so that we can have investment and live better happily ever after. Darryl, what would you have to see, what would you be looking for to see whether this liquidity in the bond market was a bigger problem than you suspect? What would be the warning signs that would tell you that it might be too early to tell, but it's not too early to worry?
I mentioned already the reduction in the repo market. That's a clear danger sign in terms of liquidity. I don't think it's a financial stability problem per se. I think you should look to costs of issuing debt, because we've been talking about the secondary market where already issued debt is traded. But why does liquidity matter? Well, in part it matters because when the United States government wants to roll over its debt, it wants to get a nice low interest rate. And if secondary markets are illiquid, the United States government, therefore all of us in the room mostly, are going to pay higher taxes to cover that debt. That's important. And then you already raised the point of, could there be down the road somewhere a shock to the market sufficiently large with insufficient liquidity to absorb it that somehow propagates to other players. And we haven't yet got the end of that story.
And there isn't any sign, is there, Victoria, that corporations, or at least investment-grade corporations, are running into higher transaction costs to sell debt, are they? They're selling a lot of it.
And the same is true for the high yield segment, because the shortage in mutual funds that we observed over the last 8 quarters or so was more offset by presence of CLO issuance. While
Collateralized loan obligations.
Yes, collateralized loan obligations.
Let me ask one final question before we turn. So I think the reason that people worry, or one reason people worry, is they recognize that we could have a big reaction when the Fed starts raising rates. If not the first time, then when the markets conclude that rates are going to go up a lot faster, and it could be a very disruptive event. And if it's going to be disruptive, seems like one place it might be disrupted is the bond market. Do any of you have any concerns that we're too much extrapolating from this period of tranquility now, and that we'll look back a year or two now and say, like, well, that wasn't the representative period?
Yeah. Well, as I mentioned, that might actually improve liquidity because there's going to be more reasons to rebalance your positions, more trade, more turnover.
Right.
And it's not as though we haven't had time to prepare it. The Fed has been telling us for quite some time, get ready, we're going to start doing this soon.
Right. The only volatility was the day they said they might do it and didn't, right?
I think as some of the emerging market governments have said, let's get on with it and see how it works out.
Okay, I'm sure they'll have some questions. Phil Suttle here.
Thanks, David. Phil Suttle from Tudor Investment Corporation. Actually, one observation up front. August 07, didn't a closure of or the closing the gates by a mutual fund in France actually kind of wasn't that the first domino in the whole crisis. So the idea that mutual funds can't have systemic implications strikes me as a little odd. But my question is really partly based on Nelly's slide on the growth in the post-crisis period and the growth of the ETF market. Because I think when we think about concerns that we have about market structure and how it could go wrong, you know, it typically comes from a market where you have illiquid assets backed in some sense by a promise to deliver instant liquidity. And that seems to be the ETF market in a nutshell. And we saw some of this in August this year when, I can't remember the exact data, but something in the first 15 minutes of trading, the SPX, which is the most liquid ETF, was trading at something like a 20% discount to underlying for just a little while, but it was enough to really scare people. So I wondered if Nelly in particular, but other participants had some thoughts on whether it's really the ETF market we should be most concerned about.
So in August, that particular incident was an equity ETF, which was related to the late opening of the NYSE and the quoting of stocks. So I think it was China over the weekend. Futures were down before the NYSE opens, and so then there's standard procedures for how you open stocks, and so many stocks, maybe like 800 or 1,000, didn't open on time. So ETFs couldn't quote the underlying stock prices, and so there were some big gaps in there. I didn't hear, so that was the issue, and I think that is something that could be remedied. They could not allow ETFs to trade until the underlying stocks were also trading. That could address that. I didn't hear issues in terms of bond market ETFs, which I think some people have raised more questions about. So it is a liquidity issue, but not, the stock markets have practices in place where they know how to open and close stocks. These things with big price moves. I don't think we took a big lesson from the liquidity yet, but it was something to watch.
Anil?
Anil Kashyap, University of Chicago. I guess I have a hard time getting this to a financial stability story, but having pressed people in the markets, I think the story goes a little bit like this, which is the high-frequency trading has meant that the bid-ask spreads now don't mean what they used to, because the trade sizes have fallen so much that we don't really know that if somebody had to put through a big trade, what it would mean. So a lot of the calm indicators are untested. So I think the best story for financial stability would be, let's suppose something happens late in the day where you get one of these big spikes because somebody has to put through a big trade, and then you see movements that are very, very large and a bunch of closing prices get quoted in the middle of one of these flash crashes. Does that strike me as super likely? I don't know, but I think the thing to keep your eye on is when we get back to more normal trade sizes, or whether we ever will. And if we never do, then I guess you're only going to find out when the tide goes out as to how this all works.
Okay, I think there's one on the aisle here. Pete Kyle. Pete, raise your hand.
Hi, I'm Pete Kyle from the University of Maryland. You presented some information from a pessimistic standpoint, and when I look at it, I see optimism. So you talk about declining trading volume in bonds, but yet the rise of mutual funds and ETFs. And I don't know whether your volume statistics included not only net redemptions from mutual funds, but all the gross redemptions from mutual funds. That should probably be factored in when thinking about how much volume there really is in terms of change of ownership in bond markets. And similarly for ETFs. You talked about banks making less money off of their dealing activities and having less repo position. Well, making less money off their dealing activities means our customers have more money in their pockets. That to me is good. The banks having less leverage on their balance sheets. Well, look at the picture we saw of the banks' long corporates and short treasuries in massive quantities leading into the financial crisis. And then when the financial crisis hit, they had to delever. So they got crushed not only on liquidating their bond markets, but they also got crushed on liquidating their treasuries, which were skyrocketing in value at that time. So it seems to me that things are probably much better than you than you say, and that if we do see what would look like a run on mutual funds, what we should expect to have happen is for spreads to widen, bond prices will fall, the market will clear. The companies that issued high interest rate debt will have a chance to buy it back at even higher rates. And that's the way markets are supposed to work.
Any comment?
I'll take a quick shot at that. I was already the optimist relative to Gary, so things are looking even better as you go down through the audience. I think some of what you said is true, because we're taking some of the action away from the core payments and settlement system, where a lot of it doesn't need to be. It could be in the asset management industry, far away from banks, and not impair them. One of the things, though, you said can be taken two ways. When the banks make less money, somebody else is making more money. Well, yes and no. Nellie mentioned the idea that now that the market is more transparent, banks' bid-ask spreads are narrow, they're not going to make as much money, and their customers are probably going to have less trading costs. On the other hand, the prices they're charging are for a service, and some of this reduction in bank revenues is a reduction in the amount of services supplied, so turnover down, for example. So there might be less, this is what liquidity means. It might be more costly to move positions through, or it might take you longer to do that because of this. And as I said, this is a trade-off I'm happy to make, but we just need to be aware of where it's going.
Steve, last point.
Thanks, Steve Cicchetti, Brandeis International Business School. I have two quick points. First of all, I just want to point out that what you just said, Daryl, is again an intended consequence, which is the idea is that the low cost of bank balance sheets, the low cost that banks had for having their balance sheets large, was effectively subsidizing the trading in a lot of these markets. That subsidy's now at least been somewhat removed, and so we have to decide how we feel about the fact that the costs have now gone up. But we might ask whether or not having stronger institutions means that if the cost of trading does skyrocket, they will be strong and have capital ready, that they will be willing to devote to now a higher return activity. The question is whether they'll have the infrastructure for that. I have a separate question, though, about market structure. The Treasury, the U.S. Treasury issues 300 and some securities. Large corporate issuers issue many, many more. And this is, forget about leveraged loan issuance, okay? But I have some numbers here, like J.P. Morgan issues 671, Bank of America 1,066, Goldman Sachs 1,783 separate bonds. Can we do something? It seems to me that that's a prescription for illiquidity, and a prescription for problems in bond mutual funds if they start holding this stuff. Is there something that we can do to improve the standardization of corporate bonds and make that market more liquid that direction through a structural change?
I'll comment. First comment. The corporation seems very uninterested in that proposition. So, it does get raised with them, and there are some who have benchmark issues, but in general, they like the flexibility. They have certain investors they like. They want to be able to offer them what they want, when they want it. So it has been raised. A few companies do this. The UK reopens their gilts. The US doesn't.
Thank you for the opportunity to tell you that during the coffee break, you can buy either Ben Bernanke's book or a little book that we've published at the Hutchins Center called The $13 Trillion Question, in which John Cochrane makes exactly the point that Steve says, and why is the Treasury creating all this arbitrage opportunity for the bond market? Why don't they issue perpetuals and take some of the rents back from the dealers for the benefit of the taxpayers? We're going to take a break of about 10 minutes, so we'll get back here at, say, 3:35 to hear from Dan Tarullo. Those who may have questions for Daryl or the other speakers, we'll have a little panel at the end. We'll have more time for questions. So thank you all. Come back in 10 minutes.
talk to you, I'm sure.
I know.
Okay, if I can ask everybody to return to their seats, and we can go to the next event, the next chapter here. It's my great pleasure to be able to introduce Dan Tarullo, who, of course, is a governor of the Federal Reserve. He served since Barack Obama appointed him in January 2009. I've known Dan for a long time, but I never actually read that stuff they put on Wikipedia about you. Nothing embarrassing, don't worry. I'm sure it's been edited by the Fed Public Affairs staff and the ethics lawyers. Governor Tarullo is probably unique among Fed governors, at least in my experience, that he actually got a master's in English at Duke before he succumbed to law school, went to law school. And of course, those of us who've been in Washington for a long time know that he spent a great deal of time as an advisor to Ted Kennedy in the days when stuff actually got done in Congress. But since he played out that string, and then he worked in the Clinton administration, but turns out you can't get anything done in the White House either. So when he had the opportunity to basically write his own ticket, he chose, to the surprise of many of his peers, to go on the Federal Reserve Board, which is not where lawyers usually find themselves. But Dan has become really the chief overseer of the banking system at the Federal Reserve. He defined his ambitions in a New York Times piece I found that the regulatory and supervisory reforms we undertake will significantly reduce the incidence and severity of financial crises, which seems to me a pretty worthy goal. You missed this earlier. Gary Gorton has given us a new goal, is that don't do things that people 100 years from now will say, how could they have been so stupid? But another of Dan's accomplishments is there's a very small set of people who command the respect of both Elizabeth Warren and Larry Summers, and Dan is in that small set. Dan Tarullo.
Thank you, David. So the topic David assigned me to for this session, I guess, was shadow banking. And I know you've been moving around a bit from around various topics, asking the question of, are we safer now? But that is where I'm going to try to focus my remarks. The financial crisis highlighted two major vulnerabilities in our financial system. First, of course, was the magnitude of the too big to fail problem. And second was the size and fragility of what was called the shadow banking system, and the extent to which shadow banking activities not subject to prudential regulation were integrated with the regulated banking sector. In the intervening years, much has been done to address too big to fail. With regard to shadow banking concerns, the specific forms related to mortgage lending that linked the regulated and unregulated sectors, such as through the notorious SIVs, collapsed during the crisis. Changes in capital, accounting, and other regulatory standards make these arrangements very unlikely to reappear. Moreover, the kind of very large non-bank financial firms whose failure deepened the crisis are now subject to consolidated prudential regulation and supervision. So in a quite direct sense, the answer to the question posed by this conference of whether we are safer than before the crisis is easy to answer in the affirmative. Of course, safer does not necessarily mean safe enough. With respect to the largest banks, we continue to pursue the aim of promoting orderly resolution through evaluation of their resolution plans and through the long-term debt requirement that we proposed a few weeks ago. In addition, the banking agencies will be proposing a net stable funding ratio rule aimed at assuring adequate medium-term liquidity over the course of the next few months. And the Federal Reserve is currently engaged in a review of its annual stress testing and capital planning exercises, one goal of which is to reflect better the range of risks confronted by these institutions. With respect to shadow banking, the circumstances are somewhat different. While the specific pre-crisis linkages to the regulated sector have been removed or are now better regulated, the possibility of other connections remains. More generally, risks to financial stability may arise anew from activities mostly or completely outside the ambit of prudentially regulated firms. Shadow banking is not a single identifiable system, but a constantly changing and largely unrelated set of intermediation activities pursued by very different types of financial market actors. Indeed, the very rigor of post-crisis reforms to prudential regulation may create new opportunities for such activities. The aphoristic warning to avoid too much emphasis on fighting the last war, since wholly new risks may have arisen, seems particularly applicable in this area. Yet there is simultaneously the opposite danger that the regulatory response to shadow banking will be too broad and too unidimensional. Indeed, the very term shadow banking tilts in that direction. This afternoon, I'll try to to identify some of the circumstances that could help us navigate between the perils of underappreciating the risks to financial stability arising from and the costs from overreacting to new forms of non-bank financial intermediation. Along the way, I'll be making a few points. One is that analytically, it's essential to disaggregate the various activities that fall under the loose term shadow banking and to assess the risks and benefits they present on a discrete basis. A second is that notwithstanding the manifold nature of non-bank intermediation, it still remains useful to identify the relationship of specific activities to the prudentially regulated sector. A third is that institutional considerations will be important in defining the potential and actual regulatory responses to non-bank intermediation. As you've probably inferred already, I have some misgivings about the continued use of the term shadow banking as a shorthand for various forms of non-bank financial intermediation that may need a regulatory response. The term conjures up a picture of lending and borrowing that resembles activity associated with, but not conducted by, commercial banks, which is in itself both over and under-inclusive of actual risks to financial stability. Before elaborating on this point, though, let me review how the phrase does capture well the activities that played such a large part in precipitating and exacerbating the financial crisis. Prior to 2007, large banks provided credit and liquidity support, whether explicit or implicit, for a range of intermediation activities, including finance companies, non-bank mortgage lenders, structured investment vehicles, and asset-backed commercial paper conduits. All of these entities engaged in maturity and liquidity transformation, frequently accompanied with significant leverage. Many created, through securitization or otherwise, assets that were viewed as cash equivalents, safe, short-term, and liquid. That is, at least in normal times, they were seen as comparable to demand deposits created by the traditional banking sector. Thus, what we might refer to as the prototypical form of shadow banking presented the kind of risk associated with traditional banking prior to the creation of deposit insurance, that of destabilizing short-term creditor runs that lead to defaults and asset fire sales. Bank sponsorship contributed to the illusion that the shadow bank's short-term liabilities were virtually as good as cash. Large banks also relied on short-term wholesale funding provided by the shadow banking sector as a source of cheap financing. Then, questions arose about the quality of the mortgage loans and other assets underlying the liabilities of SIVs and asset-backed commercial paper conduits, and simultaneously about the continued willingness and capacity of their sponsors to support them. Suddenly, asset-backed commercial paper was no longer seen as a cash equivalent, and a run ensued. Large investment banks also experienced dramatic runs on their short-term secured wholesale funding. As noted earlier, some key elements of pre-crisis shadow banking, such as SIVs, have vanished, and some key actors of that earlier period have been brought within the bounds of prudential regulation. Today, the shadow banking sector is smaller, and the traditional banking sector is more resilient. Nonetheless, abundant global liquidity continues to seek out safe assets, and some financial market participants will continue to accept maturity and liquidity mismatches in order to earn incrementally higher yields. The risks associated with short-term wholesale funding in particular have more receded than disappeared. Accordingly, that prototype of the precarious shadow banking model can generate new variants that should command regulatory attention. Before returning to that specific issue, though, I want to speak more directly to why, and perhaps more importantly, how, we should analyze the risks and benefits associated with specific forms of non-bank financial intermediation. Switching from a focus on shadow banking to a consideration of the varieties of non-bank intermediation reinforces the importance of assessing specific risks rather than merely categorizing activities as either shadow banking or something else. In this way, the potential over-inclusiveness for financial stability purposes of the tag shadow banking can be better avoided. Even non-bank intermediaries that engage in lending to consumers or small businesses are not themselves monolithic, insofar as the sources of their funding, and thus attendant run risks, may differ markedly. On the other hand, financial stability risks are not limited to entities or activities that seem to replicate the kind of lending conventionally associated with commercial banks. This is where the potential under-inclusiveness of the shadow banking category arises. Here again, though, it's important not to leap to the conclusion that where some risks do exist, they should be addressed in a uniform manner. For example, to take a contemporary point of discussion, some classes of asset managers, such as bond funds that hold relatively illiquid assets, while offering their investors the right to withdraw funds on very short notice, may pose redemption risks. But intermediaries, such as many conventional mutual funds, do not pose bank-like risks, since they are generally, at least, not leveraged. So if further analysis supports the conclusion that redemption risks are real, the optimal regulatory response would surely not be one that treats all asset managers as quasi-banks that need to have capital and similar bank regulatory constraints. An emphasis on actual risks can also lead to the conclusion that some non-bank financial entities or activities do not pose material threats to financial stability at all. I'm going to mention pension funds now, and you may wonder why I'm mentioning pension funds, and the reason is that in at least some efforts by some observers to begin getting their arms around what they call shadow banking, pension funds have been mentioned. But while they're surely an important form of intermediation, and if over time they don't have assets sufficient to meet their promises to plan participants, hardship will undoubtedly follow, and that's whether because they've been underfunded in the traditional sense or because they've lost money through ill-considered investments. And if enough pension plans fall short of expectations, there may be macroeconomic consequences. And if they provide short-term funding in order to increase returns on the assets they need to keep liquid, they might contribute to the risks assumed by other kinds of intermediaries. But in themselves, they're unlikely to pose financial stability risks. And I think similar reasoning would apply to traditional insurance activities. Now, even as risks associated with specific forms of non-bank intermediation are evaluated, it's important also to bear in mind the specific economic benefits of those activities. Non-bank intermediaries can increase the diversity of the economy's capital providers. To take a historical example, the creation and eventual proliferation of equity mutual funds offered a variety of savings options to American households for which ownership of a diversified portfolio of equities is either practically burdensome or financially impossible. This development posed a challenge for the liability side of banks' balance sheets as households reduced the share of their savings in traditional bank deposits. But it's hard to argue that this challenge would have merited limiting, for example, the availability of mutual funds. Non-bank intermediaries can also provide credit to borrowers that are underserved or unserved by traditional banks. It could be argued that one example of such non-bank activity is online marketplace lending that uses new sources of data and new technologies to lower the fixed costs of making credit decisions, rendering lending to some individuals and small businesses more cost-effective. Of course, it matters a great deal whether this competition to traditional banks arises because risks are genuinely lower or useful new products have been created on the one hand, or because well-grounded prudential or consumer regulations have been successfully avoided on the other. A key implication of the fact that the activities often grouped under the heading shadow banking are not monolithic is that the level of a particular activity is less important than the degree of vulnerability that it creates. Not all of what some would call shadow banking activity represents a market failure that creates excessive risk. And so it would be wrong to assume that all shadow banking ought to be regulated to safeguard financial stability. This view is now incorporated into the Global Shadow Banking Monitoring Report, which is done annually by the Financial Stability Board. The 2015 report, which has just been issued, begins by including all activities that could arguably fall within the category of shadow banking, but then proceeds to classify these activities by economic function and then by risk. The result, or the conclusion, is about a 70% decrease in the amount of intermediation that would otherwise be captured by the broader definition. So, in assessing whether regulation is appropriate for specific forms of non-bank intermediation requires the balancing of the resulting increase in socially beneficial credit, capital, or savings options against any associated increase in risks to the safety and stability of the financial system. And here I think, in doing this balancing, the chief relevant factors to consider would be the extent of reliance on maturity or liquidity transformation, the creation or not of cash equivalent assets, the use of leverage, and the degree of interconnection with the traditional banking sector. When growth in non-bank intermediation reflects a migration of traditional banking activities to less regulated entities, a number of similar considerations are relevant to an evaluation of the costs and benefits of the migration and the potential need for a regulatory response. Here, where the activity is probably quite bank-like, I'm going to revert to the use of the term shadow bank. First, to what extent does the activity as practiced by shadow banks entail reliance on leverage or on maturity or liquidity transformation that could lead to a bank-like creditor-run dynamic? Bank regulation is primarily aimed at preventing the occurrence of such destabilizing runs or minimizing their ill effects. And so the need for bank-like regulation is greater in the presence of material run risk. Second, are banks still informally or indirectly at risk despite the migration to non-bank entities? This could be the case if banks sponsor the shadow banks and implicitly or explicitly provide them with a liquidity backstop or credit support. And it would call for greater regulatory attention either to the shadow banks conducting the activity or to the bank's connection with those shadow banks. Third, is the activity at issue primarily migrating out of the most systemic banks, the global systemically important banking organizations, or GSIBs, or out of smaller banks? Migration of activity out of GSIBs might on net be beneficial for financial stability because it would leave the GSIBs less systemic, even if the activity migrates to less regulated shadow banks. Though here I would caution that an especially careful analysis would be needed before reaching this conclusion. In this regard, I'd note that one way to limit the growth of shadow banking that simply arbitrages bank regulation is to make sure that the regulated sector itself is not unnecessarily burdened. This aim lies behind our efforts at the Fed to tailor banking regulation by reference to the risks posed to the economy and the financial system by banks of varying sizes, scopes, and business activities. In addition, it suggests a couple of considerations for evaluating specific forms of shadow banking. Here, though, the relevance of these considerations is for determining whether to adjust banking regulation as much as it is for determining whether regulation of shadow banks would be warranted. One such consideration is whether the activity is high risk and whether banks have a good track record in addressing the attendant risks. Migration may be of less concern where banks historically have done a poor job of managing the risks of the activity in question. Another salient consideration is whether the activity at issue has significant synergies with core banking activities. If so, then regulation which incentivizes migration out of the traditional banking sector could damage the efficiency of banks and increase their vulnerability. Now, while I've spent quite a bit of time giving my sense that the specific risks and costs associated with a particular form of non-bank intermediation need to be assessed on a particularized basis. I should say that I also believe that the greatest risks to financial stability are the funding runs and asset fire sales associated with reliance on short-term wholesale funding. If there's one lesson to be drawn from the financial crisis, it is that the rapid withdrawal of funding by short-term credit providers can lead to systemic problems as consequential as those associated with classic runs on traditional banks. The total amount of short-term wholesale funding within the financial system is lower today than immediately before the crisis, though volumes are still large relative to the size of the financial system. Nearly half of the liabilities of broker-dealers, for example, consist of short-term wholesale funding, a level that is nearly the same as it was during the crisis. Now, numerous regulatory reforms have addressed the use of short-term wholesale funding by prudentially regulated institutions. The board has finalized the liquidity coverage ratio, is developing the net stable funding ratio, as I mentioned earlier, to diminish large banks' vulnerability to abrupt changes in short-term wholesale markets. Our annual comprehensive liquidity analysis and review provides an opportunity for supervisors to assess and, where necessary, to contain risks, require changes to the specific funding practices of large banking organizations. Finally, in order to increase the resilience of firms that continue to use significant amounts of such funding, we've incorporated a measure of a firm's reliance on short-term wholesale funding into the calibration of both the capital surcharge for the GSIBs and our proposed long-term debt requirement for those firms. But these measures, applicable as they are only to prudentially regulated banking organizations, do nothing to address the risks of short-term wholesale funding by non-bank intermediaries. Indeed, these constraints imposed on banking organizations may prompt more short-term wholesale funding to migrate outside the regulated sector. In the past, bank backstops were generally needed for shadow banks to obtain substantial amounts of such funding. But I think it not so far-fetched to believe that with time and sufficient economic incentive, the financial, technological, and regulatory barriers to the disintermediation of prudentially regulated banking firms could be overcome. Indeed, we've observed some investment funds exploring the possibility of disintermediating dealers by lending cash against securities collateral to other market participants. While it would be inadvisable to apply bank-style regulation to all entities that make use of short-term wholesale funding, a degree of consistent regulatory treatment is desirable to address bank-like risks in the shadow banking sector and to forestall regulatory arbitrage. The board has advocated international measures to forestall the development of highly volatile funding structures outside the regulatory sector. And consistent with this position, we'll be developing a regulation that would establish minimum haircuts for securities financing transactions on a market-wide basis rather than just for specific classes of market participants. These securities financing transactions, or SFTs, include repo, reverse repo, securities lending, and securities margin lending, transactions that are the lifeblood of many kinds of shadow banks. Now, SFTs are a key component of the healthy function in the securities market, but in the absence of sensible regulation, they also carry the potential for prompting the fire sale dynamic described earlier. While the haircuts and other conditions associated with securities financing transactions today are considerably more conservative than during the period leading up to the crisis, there's good reason to believe that this conservatism could be eroded as economic conditions continue to improve and credit growth accelerates. A system of numerical haircut floors for SFTs would require any entity that wants to borrow against a security to post a minimum amount of excess margin to its lender, with the amount varying depending on the asset class of the collateral. Like the minimum margin requirements that U.S. regulators have imposed on derivatives contracts, numerical floors for SFT haircuts would serve as a mechanism for limiting the buildup of leverage in the financial system and for mitigating the risk to financial stability posed by pro-cyclical margin calls during times of financial stress. Now I'm going to shift to the my last few remarks to what I've termed institutional considerations. Because while the analytics of shadow banking or non-bank intermediation more generally lean towards a case-by-case balancing of risks and economic benefits, the actual way in which these activities can be regulated depends, of course, on the structure of institutional realities. There are a lot of issues that probably are worth consideration, but in the interest of time today, I'm only going to mention two. First is the issue of what form of regulation is appropriate once analysis suggests that a response is needed. By authorizing the FSOC to designate non-banks as systemically important institutions, Dodd-Frank fills the gap that existed in the pre-crisis period when firms like Bear Stearns, Lehman, and AIG largely escaped the perimeter of prudential regulation. Designation by FSOC places firms under the regulation and supervision of the Federal Reserve Board. Important as the designation authority is to preclude the Lehmans or AIGs of the future, though, it is almost surely not the optimal regulatory approach for most activities that can be characterized as shadow banking, or that are conducted by non-bank intermediaries so as to raise financial stability concerns. The vast majority of firms engaged in such activities will not satisfy the statutory test for designation, and in any case, it's not so clear that at least some of the statutory prudential requirements for designated firms would be necessary or appropriate in dealing with the risks to financial stability posed by the activities of such firms. In many instances, and I think especially where funding vulnerabilities are at the heart of a business model, it is the activity itself that needs to be regulated in some way, whether there are a few large firms or many smaller ones involved. A tool that might be better targeted to actual risks while avoiding unnecessary bank-like regulation would be what I've previously termed prudential market regulation. That is, a policy framework that builds on the traditional investor protection and market functioning aims of market regulation by incorporating a system-wide financial stability perspective. This approach would take into account such considerations as system-wide demands on liquidity during stress periods and correlated risks that could exacerbate liquidity, redemption, or fire sale pressures. The specific policies associated with prudential market regulation might be transaction-specific or apply to certain kinds of business models. One example of such a measure is the SFT minimum haircut that I mentioned earlier. Generally, though, prudential market regulation would be a tool more available to market regulators, since it would apply to activities on a market or transactional basis. In an important speech that she gave last year, Securities and Exchange Commission Chair Mary Jo White provided a roadmap for just such a regulatory approach for the asset management industry. And as many of you probably know, the SEC has since begun to develop that approach. The second institutional issue that I'd flag this afternoon is the question of which regulators make the assessment and policy trade-offs that I'd contemplate in addressing financial stability risks associated with non-bank financial intermediation. Now, the natural answer would be the regulator with authority to act. And this may well be the best answer from a policy perspective as well, but it does raise some potential issues. For example, if regulators with responsibility for one sector believe that the failure of regulators with responsibility for another sector to act on financial stability concerns is creating debilitating disadvantages for firms in that first sector, they might be tempted to relax regulation on their firms, even though they might agree that the best outcome would be to retain their regulation while having the other sectors subject to some constraints as well. And in fact, I don't think this is a purely abstract or hypothetical possibility, because it seems to me a pretty good description of what happened in banking for a good part of the 3 decades beginning in the mid-1970s, when the banking agencies pursued a variety of deregulatory measures, at least in part because they believed that the franchise value of commercial banking was being eroded by various capital market activities that were not subject to appropriate prudential requirements. I'm going to conclude now by saying that the Financial Stability Board study to which I referred earlier notes, among many other things, that the growth of shadow banking in the United States in recent years has been relatively modest. With the regulated financial sector so much more resilient than in pre-crisis days, the financial system as a whole is obviously safer. Moreover, much of the innovation occurring in lending and payments arenas today carries the promise of genuinely increased efficiency and does not appear to be just an arbitrage against the stronger post-crisis regulatory regime. But if history is any guide, the grace period we are now experiencing will not last forever. New forms of intermediation may carry new risks, or older forms may acquire new risks as they expand and adapt to new circumstances. If we are to pursue what I think is the analytically attractive policy of case-by-case assessments that permit healthy forms of non-bank intermediation while protecting the financial system, then financial regulators will need to develop effective and supple mechanisms for what I've termed prudential market regulation. Thank you very much.
Thank you very much for that, Governor Tarullo. I'm going to ask a couple of questions and then let the audience have a crack at you.
A little too close.
That's too close. I'm not a reporter anymore. You have to worry about being so close. So I think that a caricature of the argument one hears is, okay, we had a crisis. They created a lot of regulation on the banks. That led a lot of activities to migrate to the shadow banking system. So now they're going to try and regulate the hell out of the shadow banking system, and this is an ever-ending recipe for more and more regulation, always trying to layer on, and it will either be collapse of its own weight or it'll have unwelcome effects on the supply of credit in the economy. So what do you say to those people? I know that's not your view, but what do you say to them?
Well, I think there could be a risk of that. And one of the reasons why I want to get away from the use of the term shadow banking is it tends, anybody can parse a term carefully, but in observing some of the early discussions of shadow banking among various official sector people, you did see that tendency to sort of say, we got to get everything that involves intermediation, or we have to get our arms around everything that involves intermediation with maturity transformation. And what I tried to do, David, in those prepared remarks was to, in an admittedly conceptual rather than applied way, try to identify some of the factors that we should be looking to in a fairly rigorous fashion in deciding which activities actually do pose risks. I think one of the reasons for the grace period, what I've referred to as the grace period, is because so much of the pre-crisis shadow banking or non-bank financial intermediation was actually connected to the banks generally, and particularly the largest banks. That because a stop has more or less been put to that through the bank's own changes in orientation and through regulation, there's probably a period during which there's not a shadow banking or non-bank intermediation opportunity to fill in immediately. But that's what I think could change over time. And I think we just need to be aware of that on the one hand, while on the other hand saying not everything that intermediates is a problem. Not everything that intermediates with maturity transformation is a problem. One, I think, really needs to ask the question, to develop that kind of analytic framework and ask a question, somebody, back to the institutional issue, needs to ask the question, are there real risks being posed here? Because there's always, those who are competitors will always see risks. Those who have a particular mandate may be a little inclined to see a risk because it pushes them forward, and that's why I think these institutional questions are important, to get enough information, enough analysis, but critical thinking.
Let me ask you about that institutional thing. So if we're going to have a system where we're going to do sophisticated activity by activity assessment, it seems to me that the current, too much liquidity there? It seems to me that the current setup is particularly ill-suited for that. with a variety of agencies, different mandates, an FSOC that isn't clear that it has authority. Some people have financial stability mandates, some don't. It doesn't seem like that's well suited for the world in which you're.
So I think it's early, it really is early days on that. And, you know, if you look at the FSOC reports over the last few years, I think you will find actually a quite thoughtful assessment of some things that might be thought of as potential financial stability risks. I would say, I mean, this is a little bit of Fed patting on the back, but I think within the Fed, we do have now a pretty sophisticated effort to think through potential financial stability risk. And I think it's not just sophisticated, but I think it's pretty, there's a lot of self-critical activity as well, led by Nelly's division, the Office of Financial Stability, but really including other divisions as well. And I would say that my own experience has been that in discussions with my counterparts in other agencies, we de facto are doing that kind of assessment. So I guess I would say that in the absence of a list of clearly problematic areas that clearly require action, and we're sitting there saying, why isn't anybody acting? That I think that we're getting time to develop the kinds of interactions that would allow this sort of assessment when the time comes to make it. But having said, as many people observe, there are advantages and disadvantages to a relatively decentralized regulatory system. You avoid having any one agency with dominating authority over all areas, but it does mean that by diffusing authority, you need to get sometimes more people on board before you can act.
Let me ask you one more question. So we are in a very unusual time when, because the Fed has been holding rates so low, the usual safe assets pay very little return. We heard discussion earlier of Treasury auctions at zero rate. So is it possible that people who reach for yield are not so much taking credit risk, but are taking liquidity risk in the, I don't have a better word for shadow banking, in some aspects of the shadow banking? And how do you think of that? And particularly, how does that interplay when you think about using forward guidance in monetary policy? Like, are you creating your own problem there?
With forward guidance, creating a problem? How?
By encouraging people to take more and more liquidity risk to get yield, because they know they're never going to get a decent yield in the short term.
Look, I don't think there's any question but that in a sustained period of low interest rates, that there's going to be reach for yield. I mean, it's just a fact of life. And there's a reason why accommodation as a policy is kept in place, but there are obviously some downsides to that, and one of them is the reach for yield. I think that the issue of the forward guidance, I guess I can see, and I see what you're saying about that. I think it's one of the many reasons why I at least was more comfortable shifting away from calendar-based or explicit forward guidance towards something that, I'm not going to use the term data dependent, I'm going to say outlook dependent or outlook driven. But again, in specific circumstances where you're at the zero lower bound, there may be a very good reason to use forward guidance as one of your available tools, and you just have to recognize that, again, there will be downsides. I mean, every policy action that anybody ever takes has merits, and it has some downsides associated with it. So the fact that a monetary policy action or a regulatory action creates a downside or a shortcoming is not a reason for saying that's a bad policy action. And indeed, I would say that some of the forward guidance pursued by the Fed and some other central banks in the sort of nadir of the crisis and the recession was a well-considered tool to be used under those circumstances. Whether one wants to use it in more normal circumstances is an entirely different question.
Okay, let's take a few questions. I think maybe to be efficient, I'm going to ask for a couple, and then we'll let Governor Truill respond. A gentleman there with a beard in the middle, followed by the gentleman with the beard in the back.
You can see the selection criteria.
Yeah, definitely.
The beard's left over from Halloween, so.
Tell us who you are.
My name's Nathan Copeland, New Rules for Global Finance, based here in D.C. I kind of want to come back to the point that Governor Trullo raised about the migration of activity or entities out of GSIBs and whether that's actually beneficial. And that comes back to the question about, do we understand who's in the shadow banking system? I also agree with, not a great term, but because we don't know, that's why the shadow word came up. So do you think, how do we approach that? And also, could you speak on one of the main initiatives coming from the Financial Stability Board, the legal entity identifier? And will that be a prerequisite for kind of addressing that issue or not?
Let me just take
I'm
another one.
sorry.
Take the one in the back.
I gotta use my memory here.
No, I took notes, so I'll make up the question.
Is this on?
It's on.
John Heltman, American banker. I had a question about, it's not really related to shadow banking per se, but...
We might not get an answer then, but okay.
But regulatory reform more generally. In Dodd-Frank, one of the sort of initiatives was the creation of a vice chairman for regulatory affairs. Seemed to be a cornerstone of the reform, and yet the position remains unfilled. Governor Trullo, you've been effectively acting in that capacity. Just curious why that position remains unfilled. Do you want it? Do you not want it?
So let me get Nathan's question first. So I'm glad you asked that because I should have been, I was thinking as I read the speech that I should have been more clear that what I was doing in laying out those factors, that series of questions, was not sort of sub rosa alluding to current issues or current problems or current non-bank intermediation activities that fit each of those questions. It really was an effort to distill from pre-crisis experience, going back some ways, a set of questions or criteria which one could ask as a particular form of activity came before us. And you'll note that I qualified that one on the GSIBs by saying I thought we needed to be particularly careful or cautious in doing that analysis. The reason I thought we need to be particularly careful about it is, it's got this premise, well, if you reduce the systemic footprint of a GSIB, that's kind of presumptively a good thing. And, in isolation, that probably is kind of presumptively a good thing. But the fact that it migrates to the unregulated sector may carry with it costs that exceed those that would be associated with it continuing to be conducted within even the largest banks in the regulated sector, precisely because there are regulators watching what happens.
What kind of activity are you talking about there?
That's why I wanted to be...
You don't want to say?
I don't want to,
Okay.
because I don't want to suggest that there is something in particular.
Okay. Legal entity?
On legal entity, legal entity is, I think legal entity really is an important...
Define what it is for...
the legal entity identifier is just an effort basically to get a standardized system throughout the world of identifying counterparties in financial transactions. And that, among many other things, will allow the aggregation of data with more of a sense of who's exposed to whom, either within financial institutions or across financial systems. It could well help with shadow banking insofar as you ask yourself the question, what are there intermediaries who are actually getting a lot of their funding from the regulated sector? And thus, in a sense, the regulated sector is taking on some of the risks of the unregulated sector. But it actually, it has intents and uses far more general than that.
And you want to take why haven't you appointed yourself the vice chairman yet?
I gotta ask the administration, can't ask me.
Let's take a couple more, if we have them. Woman standing in the blue?
Without a beard.
That'll be it, yeah.
Without a beard, I said, not with that.
Oh, without a beard, sorry.
Rena Miller with the Congressional Research Service. I'm just curious, to what degree are you concerned about overseas activities through affiliates kind of escaping the mesh of various regulations, whether it's market-based on derivatives or whether it's entity-based, and in practical as well as sort of legal terms.
Right. Okay. So good question, and I think we need to distinguish between the regulated firms that are regulated and regulations that are applicable to activities. So with respect to firms, I'd say two things. One, the reason we have consolidated regulation and supervision is precisely because of what has been learned about the potential for problems arising in the overseas activities of a firm. And this is BCCI. That's sort of the poster child for that. When you have consolidated regulation, you, for example, with respect to capital, you have a consolidated balance sheet that looks at all the assets and that constructs leverage ratios and risk-weighted capital ratios, and in our case does stress testing against that entire balance sheet. Now, I don't think anybody would believe that we at the Fed and the OCC and the FDIC have as granular a window or a window onto what's going on in other markets that is nearly as detailed as the one we have in our own markets. But that's where, among other things, supervisory cooperation comes in. So for us, for example, the Bank of England is an incredibly important interlocutor because all of our large broker-dealers and our large commercial banks have substantial London operations. So we require, on a consolidated basis, that capital be developed, and you see the counterparty risks across the whole firm on the one hand, and on the other hand, we have the advantage both of the fact that those firms have to be separately chartered in the UK and meet capital and liquidity requirements there, but also that we hear from the PRA, which is part of the Bank of England, as indeed they hear from us on their banks here. Now, with respect to activities, is obviously a different potential issue, and there I think you sort of have to make a judgment as to whether, if the activity is abroad, theoretically it's not affecting your financial markets. So if you're not capturing it as part of your firm oversight, and that because you're not particularly worried about the actor, just the act, then you might say, well, it doesn't matter if we don't have a window onto it. If you're worried about the actor, presumably you should be regulating the firm. If you're worried about arbitrage or unfair competition, then you really need to be moving towards some sort of international framework that creates at least workably convergent regulation, which, for example, is what we've done with over-the-counter derivatives, looking for common margining practices there. It's part of what animated the initiative on securities financing transactions. Why did we want to extend that framework to SFTs between non-bank actors, which today account for a very small proportion of activity? Well, the reason is because it would be so easily arbitrageable. It could move very quickly, so you want to have a convergent set of regulations in place. So the policy decision there basically is, if it's outside of your market and it's not by a regulated firm, presumptively, you might think, well, this is not really of concern to us, it's someone else's financial stability, unless you're worried that this is just part of a big arbitrage action, and if things are easily arbitrageable, it pushes you towards some sort of international framework.
I'll ask you one final question. You had this nice phrase in your speech about, we're undoubtedly safer, but are we safe enough? Mm-hmm. When you look across all the things we've done, how do you answer that question?
I mean, the concept of safety and financial stability, I think, necessarily needs to be dynamic, David. And so, as we sit here today, and as Nellie does her quarterly briefings of the board, it feels obviously and substantially safer than a decade ago. But the very nature of financial markets is one of a lot of adaptation, one of a fair amount of arbitrage, fair amount of innovation. And so the reason I asked that question about safer is, and why my conclusion said we got to push towards what I call those more supple analytic and institutional mechanisms, is precisely because the moment where you tell yourself, hey, we're safe enough, is when the problems are going to start to arise. And you don't even have to go down a Minsky-like road. You might want to, but you don't have to go down that road in order to think that is where you're going to start.
Okay, so we can never answer the question, yes, we're safe enough. Because that would be self-defeating.
Yeah, I think that doesn't mean you always need more regulation at a particular moment in time, but I think the analytic and regulatory processes always need to be aware of what's changing in markets.
Okay. Well, please join me in thanking Governor Trullo for his time. And to comply with Fed ethics regulations, you have to move that way so Bernanke can come up this way. And can I ask Daryl and Anil and Gary to come up and join me for our final conversation? Thank you very much, Dan.
Sure.
Okay. All right. Gordon has special permission to leave 4:45, so we can 5:15. They're unpredictable. We won't know for 50 years. Yeah, first. So maybe I can start, Dr. Bernanke, by asking you about the question that Governor Trullo posed in his speech. So I don't think there's going to be any argument up here that we are safer. But where do you worry that we're, if at all, gone too far? We've made ourselves so safe that it's hurting the economy. And are there places where you think we really need to pay more attention to minimize the risks of future financial crises?
Well, just to reiterate, I think we are a lot safer. And I think what's important is that, as Dan was talking about, is that the regulatory system now has adaptive mechanisms that it didn't have before. So if a new type of firm arises that has a new kind of charter for some reason, or a new type of a set of activities, there exist mechanisms for evaluating the systemic risk associated with it and potentially regulating either the firm or the activities. An example of that, well, there are many examples. The FSOC is one example. But I think the living will process, for example, where the Fed and the FDIC are evaluating the structure and the resolvability of large institutions with a process in place that over time will move towards a situation where either those firms are resolvable or they're simplified or some other change is made. So the point is that the potential for addressing dynamic change is in the system. I don't have any, on the question of risks, I just make one comment, which is that one of the things that Nellie does in her office there, her office asks two kinds of questions. The first kind of question is there an area where asset prices are somehow wrong in some fundamental sense, or where activity is risky in some sense? That's the first question. Can we identify problem areas? But then the second question could be summarized as, so what? Suppose that there is a housing bubble, but the question is, if house prices decline by 30%, what are the implications for the financial system, for the economy? It's those two parts that we need to look at. I think we should ask Nellie the question because she's been doing the work every day. I don't know of any area that is posing an immediate risk to the U.S. economy, but I'm glad that the office and others around the regulatory system are doing constant monitoring of those areas and thinking about the consequences if, in fact, some price or some risk materializes.
And let's say, God forbid, we have another big financial crisis. Are you at all concerned that the changes that have been made by Dodd-Frank and others to the Fed's ability to act in a crisis will prevent a future Federal Reserve from doing what you did? Or is that just something that worrywarts worry about?
Well, I hope that we wouldn't have to do, the Fed wouldn't have to do what we did. I think
we won't know until, according to Gary, till after we're all dead.
That's right. So. Well, that'll be good. Dodd-Frank has in it what I thought of as a bargain, a deal. And the deal was that there would be further restrictions on the Fed's lending authority. For example, the Fed cannot lend to an individual firm to prevent it from failing. It has to get the permission of the Treasury Secretary. There's also new rules about disclosure of who's borrowing. So there are some added restrictions. Importantly, the ability to lend in a programmatic way across a class of borrowers is preserved, and I think that's very important. So there were some restrictions placed, but in exchange for that, there were new authorities granted, particularly in the framework of the liquidation authority, which provides a much more systematic way both to put a firm out of its misery, so to speak, at the same time doing it in a way that preserves financial stability. So I think that bargain, remains to be seen. We never know for sure, but I was willing to, personally, I was willing to accept that bargain because I thought that overall it did some important things, including not only making the system safer, but also making the reaction to a financial crisis more legitimate, more democratic, because now the Congress has laid out a set of rules, and now there's a process that's being developed. So I think all that is, on net, is probably an improvement. I do worry about some confusions about the Fed's lender of last resort authority. I think it's absolutely essential that the Fed remain able to lend to broad classes of borrowers in the event of a financial crisis, and the inability to do that, I think, would be a very serious problem.
I'm going to introduce Anil Kashyap from the University of Chicago Booth School, who has partnered with us in a couple events. And Professor Kashyap, I wonder if you could pick up where Dr. Bernanke left off. So have we done things that are going to make it harder for the Fed to save us from another catastrophe? And how do we even know how to think about that?
Yes, certainly we've done some things. I think just step back and think about what the narrative for Dodd-Frank was. Almost all of the narrative for Dodd-Frank was too big to fail. Almost everything Governor Trullo said, which I agreed with fully, was about how there were runs and all these nefarious ways in which maturity transformation was taking place that collapsed under stress. Now, if that's the diagnosis, and that's mine, you wouldn't have organized Dodd-Frank the same way as you have. Whatever you want to call the shadow banking stuff, the stub of that collapsed would have been front and center. And if you check through the boxes and you ask yourself, how well did we do on tri-party repo? Only because of the New York Fed. Asset-backed commercial paper, well, it's gone, but there was nothing in Dodd-Frank. Broker-dealer funding model, not so well attended to. Derivatives, some central clearing, some improvements on margining, still not so great. Repo markets, talked about that a lot, just bilateral repo and securities lending, again, not central to what Dodd-Frank was about. So I don't think Dodd-Frank aimed its cannon in the right direction. Now, it sprayed a lot of stuff out there like a Scud missile. It hit all kinds of things. Sometimes that'll work. But I think the combination of that and the dial back on 13.3 leaves me feeling not nearly as safe as we need to be.
And you were telling me earlier about some experience you heard that the regional Fed banks had with a kind of table war game thing.
For people that are interested in this, if you want to have a scary scenario, the Boston Fed had a very nice conference on whether or not the Fed should have a third mandate for financial stability about a month ago. And in the run-up to that, there was a study that was commissioned that was put together by staff of several reserve banks, I guess New York and Boston mostly. And it was a tabletop, that's Fed speak for a war game, scenario that went a little bit like this. We're in 2016. We're seeing that we've hit 2% inflation. Growth looks pretty good. The unemployment rate is stabilized at the NARU. But the commercial real estate market is taking off, and most of the funding is coming through securitizations and not through the banking system. And then you look at the tools that Dodd-Frank provides, and it's pretty sobering. There's no direct way to clamp down on the shadow banking activities that are being used to finance this boom. Many of the things that the Fed would have to do require long leads, advance notice of proposed rulemaking, then comment after comment after comment, and then eventually you can do something that's indirect. And so I think that's a pretty scary scenario. And, by the way, it ignores all the questions of political legitimacy. We don't know what would happen if the Fed or anybody in the U.S. government was trying to clamp down on housing lending. I don't think we've laid the groundwork to do something like that. It took 20 years to get inflation targeting through with massive determination, and we haven't invested in using these other tools. So you can get that working paper right off the Boston Fed's website. It's got tabletop in the title, and I encourage everybody to have a look. And
So, Professor Gordon, so it turns out you're not the only worry word in the panel.
I think I have a little bit of optimism on this, though.
Okay, good. So, well, go ahead.
Well, I think one thing that did come out of the crisis, which I think was really great, is the stress tests. And I just think as a tool going forward and becoming more sophisticated, the stress test is fantastic. But one of the reasons it's fantastic is that most of the regulation has written down rules for banks to follow, especially risk-weighted assets.
Mm-hmm.
And as soon as you specify rules, they're instantly gamed. The stress tests move the discretion back to the regulators, which is the way it used to be in that period where we didn't have any problems. So I like the fact that the discretion is in the hands of the regulators. They don't tell the banks the model. And I have a lot of confidence that these models, these stress tests can be increasingly sophisticated. I mean, on-site examination, it's just no good.
So you like the stress tests for the very reason that the banks hate them?
Yes.
But Gary, we don't stress test insurance companies. There's all kinds of stuff happening where there's no stress test.
No, that's true.
We can fix that.
I'm not saying it's a panacea. I'm saying it's one really good thing that came out of the crisis.
But let me ask you, so what you taught us is that, and Dr. Bernanke has written about this as well, is that one way to understand the crisis is we had a run. It wasn't on the banks because we have deposit insurance. It was on all the other institutions that had short-term liabilities. Are we well positioned to avoid the bad effects of a run on those markets? Have we done enough there, or is that where we're not?
So, I mean, when you think about that, right, the repo market is short-term debt that's backed by, say, a mortgage-backed security. Right. So you can look at this transaction, you can do one of two things. You can beat up on repo, or you can say privately produced collateral, securitization, is not regulated or overseen by anyone. So why don't we focus on trying to get some oversight of the privately produced collateral, because we don't know how much repo there should be. So I think we went about this, the wrong way. And I think, I was just at a conference at the Bank of France called "How Do We Revitalize Securitization?" And I think that is a pretty big problem. But that was the other road we could have taken, and I think that's the road I would have taken.
Do you want to weigh in on any of this, or do you want to help me answer the question of what do we need so we are closer to being safe enough? Your choice.
It's part of the same conversation.
Great.
I mean, let's talk about repo. Anil and Gary already mentioned it. The foundations of the infrastructure for the repo market are not sound. Still, they've been improved a lot, but there's a lot more to do. When a very large fraction, say half the repo market, is cleared in commercial bank deposits, when international standards are that it should be cleared in central bank money, or at worst, in the money of a bank whose only purpose is to perform that utility function. So that's one issue. Another one, Governor Tarullo alluded to the idea that we can use new information systems like LEI, Legal Entity Identifier, to better map the risk flows in the financial system. I still think we have a relatively better visibility within the banking system, but outside of the banking system, if we were to map those risk flows better, we could do better. The foreign exchange derivatives markets could have been treated with the Dodd-Frank statute, but the United States decided, the Treasury Department decided to exempt the FX market from that treatment. There's a lot of ongoing work on the failure resolution of financial market infrastructure, and I think a lot more could be done there. There's no operating manual yet for what to do if a central counterparty, one of these big new central counterparties created by Dodd-Frank, for it to be unable to meet its obligations.
I mean, the clearinghouse itself.
A clearinghouse, right. We have the principles, those are agreed on. But as far as if it happened today, where's the checklist and who do you call and who do you send to do what and under what conditions do you interfere with the recovery plan of that clearinghouse? That's still all to be worked out. So there's plenty of work ahead. There's lots of full employment for those in offices like Nellie's office for the next 5 to 10 years.
Nellie, you're the hero of this whole conversation, right? Yeah. You realize that your human capital is denominated in financial stability. Can you just explain a little bit what you meant about what you're worried about in the repurchase market, the repo market? What is it? What's the problem and that's unaddressed?
Okay, so I'm not suggesting this is an impending disaster, but it's just bad design when a multi-purpose risk-taking financial institution like either of the two clearing banks, Bank of New York Mellon and JP Morgan Chase, we depend on the viability of the deposits in those banks for purposes of settlement of a very, very large financing transaction, securities financing transaction called overnight repo. So if, for example, even if the primary dealers are all fine and the cash lenders are all fine, if for some unrelated reason, operational, credit risk, something else entirely, people said, wow, I don't think I want to get my cash today in deposits of that particular bank, they wouldn't roll over those loans. And then all the people that depend on getting financing operationally have nowhere to go. You can't actually pull out all the plugs at one place and plug them in at another place on short notice. So if that were, standalone utility, use a metaphor with kind of stainless steel, thick-walled tubing, and no place for those pipes to get corroded by other activities, that would meet international standards set out by the CPMI.
Should I worry about this?
Well, possibly. I mean, you can always come up with all kinds of scenarios, I guess. But I guess I would make just two comments going back. I agree with the comment that repo and short-term funding was a big issue. But just two comments. One is that there has been a lot of progress. There's no question. Now we don't have the investment banks, independent investment banks, who are completely financed by short-term uninsured funding. The repo market has been improved in a lot of ways in terms of including operational improvements. So that there has been significant improvement there. But also, as Governor Trujillo was talking about, there is now a very different approach, which is the so-called macroprudential approach, which in this context means that it's not somebody else's problem. There are people, including people at the Fed, who are trying to look at these systemic issues. And as the governor was saying, I think that the tools, the regulatory tools, are in place to address these things over time. But they're complicated problems, and it takes time to implement everything. It would be a different thing if there was a building problem and nobody had responsibility for it, nobody had any way to address it. I don't think that's really the case. Now, are there, financial regulation is a very complex matter, and supervision can fail and so on, but I do think that we have a more dynamic system now in terms of the ability to address the changes and the innovations in the system better than we had before.
Professor Cassett mentioned something which is that Don Cohn has mentioned, former vice chair of the Fed, which is we know that in the past that housing and real estate is often somewhere involved in the financial crisis, and among the many tools that we gave the Federal Reserve and other regulatory agencies, we did not include any kind of way to set loan-to-value ratios or debt-to-income ratios to limit lending to mortgages, which they do have in the UK. So two questions on that. One is that something we should do? Would we be better off if we had that? And secondly, it seems to me it raises the really interesting point about even if you know the right thing to do, the politics of some of these things is extremely treacherous. And given everything you went through during the crisis, you would think that your successors would pause because there were some real consequences to the things of doing something as unpopular as saying we're making too many mortgages.
Well, the macroprudential policies come in two flavors. They come in the short-term countercyclical targeted flavor, and they come in the sort of through the cycle systemic vulnerability flavor. So the first one is what you're talking about, is that we determine the house prices are too high and we put on some kind of capital requirement or some kind of down payment. By the way, a capital requirement would be a little more subtle and more indirect than the down payment requirement. But those do raise problems. They raise problems with democratic legitimacy and conferring with Congress. And also this is the problem of that in practice it's hard to identify these kinds of things. So in the U.S., for both political reasons and maybe even for more fundamental reasons, we have focused so far at least on so-called through the cycle or systemic macroprudential policies which try to increase the resilience of the system to any kind of shock, wherever it might come from. Example of that would be the big increase in capital and the stress testing, which is a way of, the thing about stress testing, the flexibility of stress testing says if you're concerned about CRE, commercial real estate, you can stress test specifically on that risk. So yeah, I agree that it'll be interesting to see how the UK and Canada and Asia, with some of these different responsive short-term macroprudential policy. It'll be interesting to see how they work. We'll learn from that. Whether the U.S. will ever adopt that, I'm not sure. But a pretty good substitute for that is just making sure the overall system is very resilient.
Okay, I'm going to turn to questions. I wanted, Victoria, Betsy, do you want to weigh in on anything? You don't have to. I mean to, this is not pre-worked out. Well, sure. So, okay, wait for the mic.
The two questions. One is on the degree of work on these viewed as systemically important institutions globally, in the sense that we have the narrative for the U.S. It's more advanced than what we have seen in Europe, which is still yet again way more advanced than Asia, parts of Asia at least, big parts of Asia with big banks. So I'm wondering what the next steps are, or is it important to have next steps with regard to aligning these major geographies? Is that important, yes or no? And in particular, I'm thinking about things like, at one point, the risk-weighted asset density was going to be, homogenized across these different geographies, and I'm not sure if that's a pipe dream or if it's a possibility. And then the second is more of a micro question. I get the sense we care really today about systemic risk, but what are the implications for some of the quote-unquote shadow activities that are probably not systemic today, but are a major sea change from what we've had in the past and are unregulated, because you're talking about institutions that are at a state level that might not be captured in these discussions. Do we care about them? At what point is the tipping point to care about them?
You want to try?
Sure. On international cooperation, there's different levels. And again, Governor Trujillo talked about it. You have supervisory cooperation. You have regulatory agreement, but the Basel standards, of course, are minimum standards, and the U.S. has chosen to be tougher on some dimensions, which has cost and benefits. I mean, the benefit is you have a stronger system, and that's a positive. And then there's the coordination on resolution, which is something that the international bodies are looking at. I hesitate to give any impression of speaking for the Fed, obviously, since I'm no longer there. But when I was there, we were doing a certain amount of work with particularly the Bank of England and a few other, ECB, and a few other institutions, where the bulk of activity for most of the key multinationals that are at least headquartered in the U.S. is in 2 or 3 other major financial centers. And so working with them gives you a pretty good, purchase on what's happening in that institution. But that is, and this is what the tabletop was about, was trying to work with other regulators around the world. I don't want to get too far into the technicalities, but the single point of entry, for example, which avoids actual bankruptcy in many cases, except maybe at the holding company level, is one way to minimize all the legal complexities involved once a bankruptcy is declared, and it triggers all kinds of other provisions. On shadow banking, again, I would reiterate that there's 2 questions. What can go wrong, and what is the implication of that for the stability of the overall system? And that would be the litmus test, trying to think about what the implications are of some scenario and how much it endangers critical institutions, critical markets, and the broader economy. And that's an assessment that, once again, Nellie and her team are always working on.
I mean, I think we'd be in a much better place if the suggestion by Governor Tarullo was close to being operational, which is once we identified an activity that was a problem, we had a way of chasing it. So the thing that Betsy was suggesting, something small, but we know it's dangerous from the start, is very different, because then you'd have a motive for going after it, and you'd try to chase it around if it migrates from one place to another. But I think everybody's on board with this activity-based view of let's figure out what's dangerous and deal with that and not worry about institutions but worry about activities. But our regulatory system's just almost ideally positioned not to be able to do that, because we have all these 10 regulators that all have their turf and their mandates that are different and so on. So, I'm not too optimistic on that.
Gentleman there, stand up if you would so they can find you. And remember to tell us who you are.
Manmohan Singh, as a citizen. So here's my question.
Use the mic.
Put the mic a little closer to your mouth.
With regard to Anil Kashyap.
Brendan, is that on?
He's got to point it.
With regard to Anil Kashyap alluding to the 13.3 with the Fed, and if you look at what's happened and a lot of focus on the SIBs, it's very likely that some of the market plumbing will crack and it will show up in the non-banking or shadow banking. Now, from a taxpayer perspective, isn't there anything in the Fed or the regulators' mindset that ultimately we will have to bail out someplace, and we have put all the ammunition at the SIBs? I mean, look what Professor Duffy just mentioned, that since Pittsburgh, April 2009, we have been struggling with the CCP mandate, and now we are struggling with the recovery of CCPs. At the same time, we are thinking about putting repos also as a utility. So at the end of the day, it looks like under the rubric of shadow banking or utility, we may end up, because of a section 13.3, bailing out part of the financial system, which will not be a bank, but is most likely going to be someplace in the system. And I think, unlike a bank where there is a depository part where the taxpayer has a vested interest, in the non-bank, you don't have a depository part. So can't the ex ante rationale for the lender of a last resort for non-banks be such that it is much more difficult for the taxpayer money to be used in the non-banking side?
Do you want to take a stab at that? And you can reinterpret the question to when you want to answer.
Right. Well, I'm not a legal expert, but my reading of Dodd-Frank says that in Title VIII, the Fed does have the ability to provide liquidity to financial market infrastructure under certain conditions. And given that, and I think that's appropriate, given that they're now systemically important, given that, I'm not as, I guess, as concerned as you are about that particular point. It is true that I am concerned, as I guess Anil mentioned, that 13.3 doesn't, is proscribed now from allowing the Fed to provide liquidity to an individual non-bank, whether or not its failure would cause a financial crisis. And there could be some of those in the financial system. But I don't think the financial market infrastructure that you mentioned falls into that camp.
You can't lend in the lender of last resort.
Not to a single. No, to a not. Yeah, you can. You could set up a program for, say, all broker dealers or something like that, but you can't
lend just to
a specific, to a specific firm. But of course, in that instance, if there's not a systemic problem across a class of firms, then you do have the resolution mechanism.
Right. The gentleman on the aisle here.
Sergey Kostev, Financial University, Moscow, Russia. My question is about Glass-Steagall. Was it a mistake to repeal it in the 90s under Clinton? And if yes, should it be reinstated now to prevent future crises?
Anybody want to take the Glass-Steagall? Professor Kashyap, was it?
Professor Gorton.
Professor Gorton. Who wants to do the Glass-Steagall thing? I could do it too, but.
I think, I think the market repealed Glass-Steagall. I mean, one of the things you have to keep in mind is that financial systems like phones, change. And we used to not have Apple phones, iPhones. So the world changes, and that happens in the financial industry. So I don't think there's I don't think there's any real sort of going back to that. I mean, the dealer banks are all commercial banks now. So I don't think it wasn't that somebody repealed it and something happened. Stuff happened, and then they finally repealed it. So I think it's sort of a red herring in all this.
I think the one exception to that is maybe Citi wouldn't have gotten so big if they hadn't thought Glass-Steagall was going to be repealed.
Maybe, yeah.
Why do you think that this Glass-Steagall thing has become such a political, like,
It's
code
a sim-
word for
it's
everything?
it's a code word. It's a symbol, but I'm really puzzled by it because if you look at the crisis, you look at all the companies that had problems. Commercial banks lost money making loans, and investment banks lost money in the securities markets, and Glass-Steagall was pretty irrelevant to that. The only thing Glass-Steagall would have done would have been prevented the acquisition of some of those investment banks by banks, which would actually, in the event, would have been destabilizing.
And Gary, do you think Glass-Steagall was justified when they passed it in the 30s?
Well, the academic evidence on that suggests that there was no real justification for it. I mean, I think the compelling research...
It wasn't at all a systemic thing. It was all about conflict of interest. It wasn't based on systemic considerations.
Can I go for David? I mean, since you want people to be snarky,
I never said that.
It's
projections here.
But I think the amount of time that was wasted on the Volcker rule just sucked the life out of so much more productive financial regulation. And that's the same symbol. Let's go back to the way it was.
You had to get Jeff Sessions' vote.
Completely ill-conceived. It failed to be implemented in any reasonable way for all the reasons that the critics had from the beginning. And we wasted hundreds of thousands of man-hours on that. That's proof that people have this just mysticism and yearning for something simpler, and you can't put it back into the bottle. That's a much more serious thing than Glass-Steagall. Volcker continues to waste time and doesn't make the system much safer.
So a ringing endorsement of democracy here.
Yeah.
Is there someone who wants to ask a question who hasn't already? Yeah, Phil, you want? Well, you have already, but you can ask one.
So
He doesn't have a beard either.
Phil Suddle from Tudor. It's just too tempting not to ask this question in light of what you all just said. So what do you think of the Bank of England or the UK's approach to ring fencing? Is that equally dumb, stupid, or is that an enlightened way of coming at it?
You want to define ring fencing for people?
I can define it. I'm not sure I have the answer to the
Good,
question.
then you don't have to answer the question. You get your brownie points that way.
So the idea is that if a bank that's operating in multiple countries were to have difficulties, then each national government may say, well, fine and good, let's to try to save this bank by resolving it at a single point of entry and open for business tomorrow. But if it doesn't work, our local depositors and creditors may lose money, and that won't be popular here at home. And we're not sure that they're actually going to carry it off. So let's just prevent any capital from moving, any capital or liquidity from moving from our borders to another country that might help get this bank resolved. Now, again, as to the answer to your specific question, I think I'd like to punt it to one of my colleagues on the...
I'll take a crack at this. So the Bank of England, well, the Vickers Commission suggested that the payment system essentially should be a public utility that was going to be super robust, and that there would be a casino outside of the boundary that could continue to operate. Now, I always had trouble with that because the parts of the U.S. system that failed was the casino, and it blew back into, there wouldn't have been a fence high enough to protect the payment system. So I never understood the logic for why they went that way. On the other hand, because they've consolidated all the responsibility and authority into the Bank of England now, the Bank of England will be held accountable, and if they can see a storm brewing, they will have every conceivable tool to try to deal with it. They made a political decision that the bank just signed on to the Vickers report and said, we think this is a reasonable first step. They may rue the day over that, but I don't see the logic for why you say you can carve out one part of the system and make it super safe and robust with much confidence.
Okay, I think the woman from the CRS had a question. And then there's one in the back.
Hi, Rena Miller from CRS. My question's on money market funds and something in Nellie Liang's presentation about, there's a first mover advantage to leaving the mutual fund in a time of stress. And there's a lot of hope put on the SEC approach with the floating net asset value and maybe, better disclosures, which have in the past not always, been that robust or really worked, particularly for retail investors, will be the solution. I'm just wondering, sort of point blank, have any of you thought that, the next crisis or a couple crises down the road, that we're really looking at something more like an FDIC or a SIPC type backing, to prevent people from running? Because ultimately it's a psychological game of getting people not to run. The just other twist on that is, if anyone has either read or even the Piketty book on capital, if we're waiting for another crisis or another crisis, and we're in a realm of widening disparities, he predicts social unrest. People may discount that. What do you think of that and the role of mutual funds and pension funds in this?
So let's start with the money market fund thing. I mean, we tried this once. We had after-the-fact insurance to the money market funds. Do we have an unsolved problem here?
It's a mixed solution in the United States. Just to back up a little bit, the proposals by the SEC were to do one of two things. Number one, stop pretending that you can redeem shares at $1 a piece when they might fluctuate below $1. That just is going to incite a run. The other alternative that was held out is to put some capital behind that promise, or move to government-only money funds. The industry is migrating, and I think Nellie may have alluded to this, or maybe it was Betsy alluded to this. The industry is migrating towards the government-only solution, not entirely, but significantly, because a lot of investors want the ability to get instant liquidity at a predictable price. Are we better off? We're better off than we were when we had a $300 billion run during the financial crisis. We're not going to get what you suggested. It's just not in the political equation, and it might not even be appropriate to get the government to stand behind it. When that happened during the crisis, because it was a massive run, Secretary of Treasury Geithner wrote a letter to Congress saying, I promise that I won't guarantee money funds again, or that the Treasury will not guarantee money funds again. This was a very exigent circumstance. And I think that that promise is going to very likely have to be kept, maybe even in a relatively extreme situation.
Gary Gorton, if there's so much demand for safe, short-term liquid assets, we know how to make safe long-term liquid assets, right? The Treasury could sell more T-bills. The Fed could even sell them. Are we doing something stupid here by not providing more safe assets to the financial system so they don't go to money market funds in the private sector to produce riskier ones?
So if you look at the fraction of safe assets to total assets, and you look at that, and then you divide the safe assets into government and privately produced, since 1952, it's predominantly been privately produced. So I think, if you're going to issue that much Treasury, that would, you're going to have a pretty big interest bill every month for the government.
No, I mean you could do more bills and less bonds or something.
Well, I think the problem is that you have some inherent features of a market economy. One inherent feature is that there's maturity transformation. This is not a choice. This is a fact, right? You want to eat lunch every day, but it takes 2 years to make a submarine. That's how to think of the whole economy. Now, the submarine has
Not the sandwich, you mean.
Yeah. I mean, the submarine has to be financed, right? So if it's mostly short-term debt that's financing it or part of it, I don't see how you can get all the investment you want by just using treasuries, which would be overwhelmingly way too much that have to be issued.
I think there's a question in the back, and then I have a final one, and we'll close. Thank you, Brendan.
My name is David Brazel. I'm sitting here listening. I was wondering if we can be, are we safer or can we be too safe is my question, I guess. Because I'm sitting here listening. We have a monetary crisis, and after the crisis, there are new rules that are put in place, and we have everyone telling us we've now solved that problem, and we should be safe now. And of course, we're really not, because people take actions to get around those rules or whatever, and it leads to a new crisis, and because of whatever moral hazard has been established because of the old rules. Can we be too safe, in a sense, that we just, all we're doing here is exacerbating the instability in the system by trying to put more government security around our
Right. So let me
and it went to the discussion you just had now is
right.
Just because we have a demand for liquidity, should we necessarily be providing all
I
that?
think you want to keep in mind that we have observed banking systems that have long periods without crises. I mean, we went through a long period without a crisis. Canada has gone through an even longer period without a crisis. So it's possible to design regulations so that you get a long period without a crisis. We passed all these laws and new regulations and so on. The question is that going to deliver this 50-year period for us? That's what we don't know. But I don't think, it's not we're just piling on more and more regulations, which is causing the problem. I mean, it may cause the shadow banking system to appear somewhere else, but we can get long periods of tranquility.
So I think there's two ways to frame this question. One is a kind of Minsky notion that if you have too much stability and too much calm, that leads people to take risks, and then you end up with more problems.
We know that from looking at emerging markets anyway, that if you don't, let me put it to you this way. Do you want 1,000 years of no crises, but you've repressed financial intermediation to the point where you've lowered the growth rate, by 3 percentage points? Or do you want to have a very vibrant period, but you get a big financial crisis every 50 years? The study of Latin America suggests you want the latter, right? That that as you were suggesting, getting rid of crises completely is way too repressive. And some people have argued that the period in the U.S. from 1934 to 2007 was a repressive period for banks. I don't have that view, but that is the argument that some make. So I think the problem is, from a public policy point of view, we don't exactly know how to design policies to even think about these trade-offs, right? We don't know that everything we've adopted means we're not going to have a crisis for 50 years, and we will have one, and that's good. We have no idea.
I think another way to ask the question, let me ask the three of you to comment on that, and then we'll close, is I want to be sure that we have done what we can to minimize the risks of much more frequent crises than carries every 50 years. But I also want an economy where there's abundant credit to finance investment, and we can have maximum possible employment and price stability and growth and live happily ever after. So when someone who's not as familiar with all the details as you all are, looks at the balance, how do you judge whether we've done too much to reduce the risk of crises at the cost of sacrificing growth or not?
So my colleague Doug Diamond says, to figure out where there's going to be a crisis, follow the short-term debt.
Yeah.
And I think that's right. And I think modern crises are at least as much about the liquidity side of it as the credit creation. So there are many ways to deliver enough credit to sustain the growth that you want. Where it gets really dangerous is where it's this short-term stuff that can be pulled quickly that's supporting the credit. And I think if we started with that, those eyes on the problem, we'd be just watching different things. I also want to endorse what Gary said about redoing our measurement. Super important to be able to look across countries and just see standards. There's no widely accepted definition of wholesale funding across the world. Unbelievable 7 years later, but it hasn't happened. That makes it hard to follow the short-term debt.
Mr. Duffy?
Well, I recall what Lloyd Blankfein was asked when whether the Dodd-Frank Act was good or not, and he said, if I had to take it or leave it, I'd take it. I mean, clearly, I think we're way further ahead now than we were 7 or 8 years ago in terms of financial stability. But as everybody has suggested, there's a laundry list of things that need to be done and that need to be improved. Governor Tarullo said, and you quoted him, you can't be safe. We're never, or he didn't say literally, we're never safe enough, but he said, he asked the question, are we safe enough? And when he answered your question, he said, the system is always changing, and we always need to keep following, as Anil said, where the short-term debt goes, where the financial fragilities are. Job's never done.
And do you think there's a risk that we've gone too far and that it's hurting economic growth and credit, or do you think that's just whining?
I'm reminded of the Chinese president who was asked what he thought of the French Revolution. He said it was too soon to tell. I think that, of course, you could, only an economist would say, the risk of financial crisis is too low.
Right.
An economist might say something like that. We would understand what that meant, but don't quote me. But I actually don't think that. We just saw this enormous cost. Huge cost, and there's not any evidence. We can see some problems in the mortgage market and so on, but we don't see any huge increase in the cost of credit or availability problems in the availability of credit. So far, I don't see the evidence that overall, in terms of systemic performance, that we've gone too far. Now, certainly, not every direction is equally profitable, and I agree with Anil about the importance of the short-term funding. I think that progress has been made there, and the tools exist to get more progress. But the too big to fail was important too, and for political and as well as economic reasons. So both of those things are important. But again, it would take an awful big hit to credit costs to offset the huge economic damage done by the crisis we just had a few years ago.
Okay. With that, please join me in thanking the panel. And I want to thank a very patient audience. I don't think I've ever done an event at Brookings that went this long, that there were so many chairs filled at the end. So that must be a tribute to this panel. If you could look at your feet, and if there are cups or papers there, pick them up and put them in the recycling, we'd appreciate it. And all this will be, the video and all the slides will be on our website, if not today, then tomorrow. Thank you all.